Trading in Francine in London with Tom McKenzie.
And here are your top stories. Bulls on the front foot, at least for now. European futures edge higher as markets look for inflation moderation. Jeffrey Gundlach says look to bonds rather than the Fed for clues on interest rates. Homegrown Apple, the tech giant, plans to start using its own custom displays in mobile devices as early as next year, dealing a blow to Samsung and LG. Plus, French labour unions respond to President Macron's plan to raise the retirement age by calling strikes and protests starting next week.
Tom, let's also take a look at the futures. Now, if you look at the currency markets, which I imagine a lot will happen there, I'm looking at euro and also sterling rising a touch. And if you look at equities, there's a bit of optimism that we're going to have a good print from CPI in the U.S. And actually, Jay Powell not talking about inflation yesterday.
Yeah, indeed. And JP Morgan suggesting that if inflation comes in a little softer, then it could continue to push what they describe as this bear market rally higher. We continue, of course, to assess and weigh up the implications for the Federal Reserve. Jeffrey Gundlach, yes, saying you need to look at the bond market rather than listening to the Fed when it comes to the trajectory for rate hikes. But Jeffries and Blackwell warning that maybe investors are getting too complacent about inflation once again. Markets expecting that inflation comes down to 2.5% next year. Is that unrealistic? The market's opening up just 0.1% here in the UK. The FTSE 100 adding 12 points. Over in France, the CAC 40 gaining 11 points. Again, it was a brace for the potential of industrial action next week. And the Spanish IBEX range-bound. Let's switch it over and see how things are playing out across assets. So you had a decent rally in US equities yesterday again, as Francine was saying, on expectations that maybe the CPI print that comes out on Thursday is going to come in a little softer. Expectations for around 6.5% after plus 7% for the month of November. Futures pointing lower by about 0.1%, though. A little bit of profit taking uncertainty. It is the inflation print that is the key data point this week. Euro dollar 107, a little bit of strength coming through for the single currency. The Bloomberg dollar index is hovering near a 7-month low. For the context, 356 on your benchmark US 10-year. That is a move of 5 basis points lower in terms of yields after a bit of a run-up yesterday. Brent, $79 a barrel, that's down 0.6%. Reports that stockpiles of oil and crude in the States slightly higher than many had expected. $79 on Brent. Francine, in fact, before we get to Francine, we're going to bring in MLive's managing editor, Mark Cudmore. Bit of a change up in the show today. Mark, you are looking at US financial conditions.
Yes, Tom. Good morning again. I am indeed looking at US financial conditions. So here's a chart of the Bloomberg US Financial Conditions Index going back over the last 3 years. This line here is the neutral line, the zero line, and the idea is that when we're above that line, we've got slightly loose financial conditions, i.e. financial conditions that are supportive for markets, for the economy, for inflation. When we're below that line, it's considered restrictive. Now, note, we've just ticked back into positive territory. That means that at the moment, financial conditions are encouraging, re-stimulating the economy, and therefore, theoretically, re-stimulating inflation. And that's going to be a big issue for the Fed, because even though inflation is coming down, the consensus forecast is still for CPI to print at 6.5% tomorrow, more than 3 times their target. So you've got to assume that the Fed is going to push back on this dynamic. Now, there are many things that fuel this dynamic. It's not directly monetary policy. Part of it is about markets themselves, the rally in credit, the rally in stocks. So they're just probably going to have to reiterate that, hey, we're not going to stop the hiking cycle quite as quickly as we think. We're not going to cut quite as quickly as you think. And I think we'll get that message in the coming weeks to drive this line back lower and therefore push back markets a little bit, push yields up a little bit, and slightly control the inflation beast before it gets re-stimulated again prematurely.
Mark, thank you so much. As always, right on the money with his charts. Our Bloomberg M Life managing editor, Mark Cudmore. Now, Belgium's prime minister says fears of a recession in Europe are diminishing, with the economy gaining a boost from lower energy prices. Well, Alexander De Croo spoke exclusively to our very own Maria Tadeo.
It's a happy new year in the sense that, well, first of all, we wish each other that 2023 would be a better year than last year. Last year was a complicated year in Europe, and we obviously would want that this war ends in the year that comes. But indeed, if you look at the economic indicators, indeed, the fear for a recession is diminishing, and there are good reasons for that. One of the reasons is indeed on the energy side. A number of things have helped. I think, first of all, the agreement on the gas price cap was a necessary one, which we pushed for a lot, and is a strong indication that in Europe we will not pay these very high prices anymore. Of course, as well, very instrumental is the fact that there's more supply coming, and that especially big countries which were dependent on Russia, such as Germany, have found other sources of gas, and the fear of gas shortages has been reduced significantly. Belgium also played an important role in that, because we expanded all the capacity of throughput towards Germany that we have for LNG, for example.
And of course, you say it's early to tell, but is there a point where you say, okay, the situation is stable? Will it be when inflation really comes down and stays stable on that front? Will it be when the consumer bills actually go down? What are the indicators that you yourself, you look to say, okay, now we're fine?
Well, of course, I think that when you see that the gas prices are going down, you can expect that the consumer bills are going to go down. But that indeed is the key thing, because that's what is driving inflation. That inflation that is driving up, especially in countries with automatic indexation, such as Belgium, is driving the wages up, which is actually hampering our competitiveness. And so prices going down is good, but it will take some months before the consumer will see it. And in the meantime, of course, we see that we are in a geopolitical competition, and that is mostly with the United States today. Their Inflation Reduction Act is something which could be threatening for industrial activity in Europe, and there we really need to act as a European bloc.
Well, that was the Belgian Prime Minister Alexander De Croo speaking to Maria Tadeo on Europe's economic outlook.
Okay, we are going to get more analysis, of course, across these markets in the minutes ahead. Just getting a little update, of course, 5 minutes into the trading day here in Europe. You're seeing very modest gains of a little over 0.1% across the European benchmark. Here in the UK, the FTSE 100 trading at 7,700. Futures in the US range bound. Coming up, going solo, Apple plans to ditch another key supplier, building on the story from yesterday, this time for screens, and turn to in-house production. We're going to get more on that next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
You're a little slow. I don't think there's any harm done by waiting 3 to 6 months to see what the full effect of this is around the world, and the reduction of wages, et cetera. So it is a wise thing to do. I'm on the side where it may not be enough.
Well, that was the JP Morgan chief executive, Jamie Dimon, on the Fed's inflation fight, actually saying he doesn't think they'll stop at 5%. Now, stocks in Asia climbed in trading today amid upbeat sentiment over China's economic reopening. That's as traders bet U.S. inflation data due out tomorrow will show further softening. Well, joining us now is Fabiana Fedeli, Chief Investment Officer, Equities and Multi-Assets at M&G. Fabiana, as always, thank you so much for coming on. Now, we have a number of banks, of course, with a number of calls on inflation, interest rate expectations. Where are you expecting the S&P by the end of the year?
It will all depend, Francine, and good morning to you and to Tom. It will all depend on what happens with inflation reading. From last year, where most of the discussion was around inflation, was around what central banks would do, now the discussion has to verge on the recession, how deep it will be, and how pronounced it will be. And depending on those readings, that is really where all of the equity markets will go.
So in that shift from inflation to the question of recession, what is your best take on what that recession looks like as we weigh up the forecast from Goldman Sachs that maybe the Eurozone actually gets into positive territory by the end of this year?
Look, Tom, I really hope Goldman Sachs is right, but obviously we have to weigh all probabilities. So there's a plan A and a plan B. The plan A for now looks like we're going to have a recession. It's going to be different in different regions. The U.S. will be possibly milder. China is on a completely different level play field because obviously we're actually at the start of a growth period. And Europe is probably, together with the UK, the area where we might see more difficulties from a growth standpoint. In that kind of situation, you're better off in fixed income. High yields give you a much better coverage for your risk. You've also seen a reset of valuations, and especially if you think that central banks are about to end, or at least they're closer to the end of their rate hikes. However, we've learned to beware of the unexpected. And if indeed the recession is even milder, if Europe, as Goldman Sachs believes, does not go in recession, then we could be in for another positive, for actually a positive year in equities.
Fabiana, we're looking at some individual stocks. For example, Direct Line. Now, this is a UK insurer. They said that they are no longer able to pay dividends because some of the news has gone from bad to worse. And this, of course, is a major shock for the markets. And I think Direct Line is down some 25%. Are we going to see certain sectors in certain countries, maybe like the UK, where you really don't want to be invested in because things are going to get worse, and at the moment we don't have that much visibility on it?
Francine, is actually going to be even more extreme than that, in the sense that we're going to probably see a redo of what we witnessed in 2022, where not only companies had in different sectors had different earnings results, but also companies in the same sector. So really differences in balance sheet strength, different in exposures to certain areas in the same sector. And you already see it now in the expectations for earnings for the next earnings season, which is obviously has just started, whereby the dispersion in those expectations is really inching up significantly. So I would say different companies will do very differently. As I said last year, stock picking really helps you with alpha this time around.
Yeah, the need to stock pick. The China element, the China factor clearly across these markets as well. We're just looking across the commodity sector. Copper currently topping $9,000 a ton for that first time since June. Part of that is down to expectations there's going to be more demand out of China, but also partly a bet as well on these easing inflation conditions. When it comes to the question, Fabiana, of Europe versus the US, the outperformance that we've seen since what, early November, Europe up around 16%, the S&P up about 9%. Does that outperformance for Europe continue?
Again, it all depends on what growth numbers look like in Europe. I mean, the US is really not factoring in much more than a mild recession. We're still 15% higher than we were in equity markets compared to pre-COVID levels. Europe is much closer to where it was at pre-COVID levels, so it still has some way to catch up. And again, if those recession numbers don't come in so bad, if the winter continues to be mild, and if the energy crisis is scaled back, it might as well be that Europe is going to outperform the US also in the near future.
Fabiana, are you expecting quite a lot of M&A this year? Is there any opportunity to get there? Where do you see the biggest value?
Absolutely, yes, Francine. I think M&A is going to be a big topic this year. You already start to see it, for example, in the UK market. This is a continuation from last year. You have a cheaper currency. You have also very inexpensive valuations, and you're already seeing some news flow just at the end of last year in the banking sector. We expect more. We see really movements across different markets. So this is a market that, because of valuations, because of sharp moves in those valuations, is ripe for M&A activity.
How do you want to play the China reopening, Fabiana?
So, Tom, if you remember, last October we came on the program saying we are adding to China because we believe now valuations are at extremely undemanding levels. That continues to be the case in some areas, but in some other areas, actually, they have improved a lot. We've seen some big rebounds. So we've rotated out of some stocks, and we have bought in others that possibly were a little bit more domestically orientated, and now we believe will benefit from the reopening. But you still have to be extremely selective. I mean, there is still regulatory pressure in China. There's still an agenda from the government, and obviously never forget geopolitical risk.
Fabiana, how do you play those geopolitical risks? If you look at some of oil commodities in general, is this going to be the big play in 2023 like it was last year?
Francine, commodities will get a boost from China reopening. But the truth is, if you look at iron ore, it's already up, about 56% since the most recent lows. Copper, you mentioned it, about 20% up. I believe there is still some room to increase on the base metal side, but also look at it laterally. Think about emerging markets that are benefiting from commodity demand increases, and also think about their currencies. So think about Latin America, think about South Africa, and think about some of the countries also in Asia.
Okay, interesting calls, and I know you favour emerging market local currency debt and also a little bit on the long end when it comes to fixed income. Fabiana, really appreciate your insights ahead of this important data point we get out tomorrow around CPI and the question of inflation as the focus shifts, of course, to the recession conversation. Fabiana Fedeli, CIO of Equities and Multi-Asset at M&G. Thank you. Now, turning to tech, Apple is planning to drop yet another key supplier and focus on in-house production. This time, it is a blow for Samsung, which supplies the iPhone maker with screens. Apple aims to use its own displays in mobile devices by 2024. That follows Bloomberg's scoop yesterday on plans to use its own chips. For more, we're joined by Edwin Chan, who leads our tech coverage in Asia. Edwin, the news flow keeps coming on Apple, and it seems to be doubling down on this effort to shift away from these suppliers. Why is it now looking at building its own in-house screens, and what are the challenges in doing that?
I think this move, along the one you mentioned on chips, as well as previous efforts to replace component suppliers. I think you have to look at it all in one piece. I wouldn't say doubling down. I say it's more of a years-long process. Now, Apple, as we know, as a company, its philosophy is to control the ecosystem and to control its broader global supply chain. And I think working on the screens is one part of that. Now, we're only in the very early innings, according to our reporting, of actually replacing names like Samsung and LG, but again, this is the broader corporate philosophy of control.
So, Edwin, what does it mean for example, suppliers like Samsung going forward?
I think most immediately, not a lot. I think you saw LG's share price go down a little today, and that's because it's more reliant on Apple. Again, according to our reporting, they're going to start with a small segment of watches, and it's possible over the longer term that we might see a similar shift in the iPhone display itself, and that's when things get really interesting. But for now, the impact, I would say, is minimal.
Okay, so it's the early innings on this shift. What does it mean for Apple's consumers?
That's very debatable. I mean, depending on the consumer, you may or may not notice a difference whenever Apple or Samsung or any smartphone manufacturer switches from one key component to another. I think a lot of this is driven, however, by the need to control the consumer experience. We talked about Apple's obsession with control. And I think controlling the user ecosystem and the user experience is part of that. And I think the theory, at least, is that if you design more and more of the components in-house, you then have a better grip on the overall user experience.
All right, Edwin, thank you so much. Edwin Chan there with the very latest, of course, on Apple. He leads our tech coverage over in Asia. Now, coming up, court documents in the FTX bankruptcy case reveal the celebrity shareholders set for wipeout. We'll have all of the details next. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising.
I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising
Yeah,
New York
the
City?
mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open, everyone. We are 23 minutes into the European trading day, and for the moment, I mean, I wouldn't write home to tell anyone about it. European stocks are a little bit on the upside, but pretty much flat. The DAX gaining some 0.2%. The focus, of course, will be on the CPI print yesterday, and then yesterday, maybe traders were a little bit unaffected by what Jay Powell was saying. He talked more about climate change and central banks than he did about inflation and forward guidance for monetary policy. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. French unions have called for a day of strikes next week as an initial response to a government plan to gradually raise the minimum retirement age from 62 to 64 by 2030. President Emmanuel Macron argues the change is needed to boost low employment rates among older people and to keep a cap on rising costs for the government. Jay Powell has set out the limits of the Fed's role in promoting a greener economy, vowing it will not be a climate regulator. Speaking in Stockholm, the Fed chair says the U.S. central bank will stick to its mandate of maintaining price stability. Powell says without explicit legislation, it would be inappropriate for the central bank to be a climate policymaker. A White House official says President Biden has asked Treasury Secretary Janet Yellen to stay in her post. We're told the U.S. president made the request, which she accepted in mid-December. The move ensures stability ahead of another upcoming fight in Congress over raising the debt ceiling. Ambulance workers in the UK are holding a second strike today as part of an ongoing row over pay in the health service amid the rising cost of living. Yesterday saw the government table anti-strike legislation in Parliament as it seeks to minimise disruption from industrial action across a number of sectors. Unions and the opposition Labour Party have vowed to fight the plans. That's the Bloomberg Business Flash. Tom, Francine.
Laura Wright here in London. Thank you very much indeed. Okay, top level, the indexes, yes, not a huge amount of interest as investors wait on the sidelines ahead of that CPI print tomorrow. But within that, if you lift the hood, there are some really interesting corporate stories to check in on. So we bring you some of the major movers of the session so far. Let's start with Bayer then, and some activist investor interest in this company. They built up a stake. It is Bluebell. We don't know how much, but what they are pushing management for is a breakup of the pharma company. They want to separate the crop science business from the pharma unit. They say that will lead to upside of more than 70% for shareholders. Also pushing for the sale of that company's consumer health arm. Another company in focus, Jay Sainsbury, giving us an update on trading conditions, down 2.8%. Jeffrey's saying that this is a bit of profit taking. The beat that came through for the third quarter and a record holiday season largely priced in, according to those analysts. And that's why you're seeing a bit of pressure on that stock, despite the fact that they came in with guidance. They say it's going to be to the top end of their guidance. Direct Line taking one of the biggest hits, if not the biggest drop on record for that stock, down almost 30% after they scrapped their dividends. A major shock, according to Jeffries. Plenty more coming up. Stay with us. This is Bloomberg.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies, and I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open, everyone. 30 minutes into the European trading day. Here are your top stories. Bulls on the front row for now, while European stocks edge higher as markets look for inflation moderation. Jeffrey Gundlach says look to bonds rather than the Fed for clues on interest rates. Homegrown tech, while Apple plans to start using its own custom displays in mobile devices as early as next year, dealing a blow to Samsung and LG. Plus, French labor unions respond to President Macron's plan to raise the retirement age by calling strikes and protests starting next week. So, Tom, away from the strikes and the protests, and we also, of course, have ambulance workers on strike today here in the UK, we look at the markets and they're pretty much flat.
Yeah, modest gains 30 minutes into the trading session today as we look ahead, of course, to that CPI print out of the US and what it tells us about the likely direction then of the Federal Reserve. JP Morgan saying that CPI print for Thursday for the month of December is likely to come in possibly softer than the forecast, and they think that will give this what they describe as a bear market rally further legs. By the way, for the context, the European outperformance continues versus the US. Whether that pushes through to the rest of the year will be a key question for investors as well. The benchmark up 53 points, up 0.1%. Over in Germany, gains of 43 points, gains of 0.3%. And here in the UK, the FTSE 100 gaining 0.3% as well. Basic resources is certainly a factor there. Let's switch it on, see how things are playing out then across these sectors. There you go. Basic resources up 1.3%. Copper and iron ore higher. Again, copper at its highest levels since June, $9,000 a ton. Iron ore above $120 a ton. Tying into the China story, yes, also tying into the expectations that maybe inflation is starting to ease. We look at technology as well, given what we're hearing from Apple and its continued efforts to bring in its own components, currently gaining 0.7%. At the bottom of the list, insurance. Down 1%, dragged lower by Direct Line and some of its peers. Direct Line, the last time I checked, down about 28%, scrapping its dividend. A shock, said Jeffries.
Well, last year, Airbus and Boeing booked their largest jet sales numbers since the start of the pandemic. Now, Airbus remained ahead of Boeing for both orders and deliveries in 2022 as supply chain issues weighed on aircraft manufacturers. Now, we're now joined by Bernstein European transport analyst Alex Irvin. Alex, great to speak to you today. How's 2023 looking for the aviation industry?
Yeah, so for the airlines, a continuation of strong demand, at least so far. We've already had 2 airlines guide up for Q4, those being Ryanair and Lufthansa. People have been worried that with the recession risk, demand is going to fall over, but so far for the airlines, so far so good.
What about capacity, Alex? Good morning. When does that come back? When is that fully restored, that capacity for these airlines?
Depends on the market. So intra-European capacity is pretty much already back to 2019 levels. We think this summer it will exceed 2019 levels by between 5 and 10%. For long-haul capacity, it takes a little bit longer. Airlines got rid of planes during the pandemic. Those planes are gone and not coming back. And of course, you're at the end of Norwegian Air Shuttle's long-haul, low-cost operations. That was about 2 to 3% of European capacity. That likely still stays below 2019 levels in 2023. And then I think we're fully recovered in 2024 on long-haul.
So, Alex, where do you see the biggest gains? I don't know whether it's Airbus or Boeing, or whether it's just a little bit too soon to know who will get the most orders this year.
I'll pass on the OEMs, but among the airlines themselves, I think the ultra low-cost carriers are probably the best place to be. As people get worried about household budgets, I can see some trading down to cheaper fares, cheaper destinations. Among the long-haul carriers, they're all so far seeing quite strong demand. Fares will be down year on year, but still ahead of 2019 levels, and things look generally okay. I prefer the Atlantic market compared with the Asian market, particularly given the inability to overfly Russia, which makes flights longer and more expensive and less attractive relative to the Middle East than they were in 2019.
So, Alice, I know you've got Wizz Air, for example, one of your picks, alongside Ryanair, and then the legacy carrier IAG. Talk to us, particularly when it comes to those lower costs and that trading down story, the ability to maintain the kind of pricing that we saw, ticket pricing and yields of last year. Is that a theme that's going to continue into this year?
I think so. So when we look at what happens to ticket pricing and yields, is essentially a function of supply and demand in the industry. Where is demand and how many planes are there in the sky? When we look at our 2023 capacity forecasts, we're basically back to the pre-pandemic trend of about 2x GDP from the early 2000s through 2023. If you add inflation to that, we tend to see flat real unit revenues for the low-cost airlines. Basically, we're saying that fares can be as good as flat year on year, which after a record summer 2022 is really quite bullish for the sector.
Alex, how does the China reopening affect European airlines?
China's an important market, inbound to Europe for tourism, and also as a corporate market. It affects different airlines differently. So an airline like Lufthansa, among the major European listed stocks, would benefit the most from a China reopening, because China is extremely important to German corporates as both a market to sell their product and as a supply market for components for manufacturing. For an airline like IAG, it matters less. Most of their traffic points west to North and South America, so it varies airline by airline. For the low-cost carriers, much smaller impact, given that they don't have any traffic to China. But when you have some Chinese tourists coming to Europe and then flying point to point within Europe, there's a little bit of capacity absorption from that. But among the major stocks, Lufthansa benefits the most.
Okay, so watching for those big spending Chinese tourists back on European soil and taking flights across the continent. When it comes to the labour shortages, many of us were impacted by this, Alex, alongside the airlines, of course. Where are they in addressing those labour shortages? Have they been successful in getting to a point where that's not going to be a problem again this year?
I'll say it'll be less of a problem this year. I wouldn't say it's going to be completely over. So there's different labour shortages we had in 2022. Some of the most acute were among personnel like security screeners and baggage handlers, and that was particularly tough at major airports. Heathrow, Amsterdam, and Frankfurt standing out in particular. They have been doing hiring. I would think that we're certainly doing a lot better. The issue is how long have those people been in role? If you've been doing that job 3 months, you won't get quite the same productivity as if you've been doing that job for 3 years. But largely speaking, we should be staffed up at airports. Another pinch point is air traffic control. So it takes about 3 years to train a controller. We didn't have enough in 2022. As we go into 2023, we'll have partially plugged that gap. Maybe not entirely, but I think 23 is going to be a lot smoother for traveling than 2022 was.
Well, that is very good news indeed. Alex Irving, thank you very much indeed. European Transport Analyst at Bernstein. Top picks including Ryanair, Wizz Air and IAG. And Francine, for one, will be very relieved to hear that maybe labour shortage. Where are you travelling on a weekly basis? Aren't you?
No, for fun. Where are we going?
Let's pick Egypt. I'm going to get Mohammed El Mashed, one of our lead producers, to give us an itinerary for Egypt. Yeah, the pyramids. Let's do it.
Done. Now, billionaire, New England Patriots owner Robert Kraft and star NFL quarterback Tom Brady are among those sharing in the pain of FTX's sudden collapse.
Bankruptcy court documents reveal Brady alone, it's fascinating, owns more than 1 million shares, ouch, which are now assumed to be practically worthless. For more, let's bring in our senior crypto reporter, Joanna Ossinger, in Singapore. Joanna, what did we learn then from these documents listing FTX shareholders? We've been waiting for these documents, now we have them.
Yeah, Tom, it's pretty interesting just to see who has had shares in FTX. And of course, as you say, these are likely worthless because shareholders are really at the bottom of the barrel when it comes to bankruptcy proceedings and who gets anything. So look who was wiped out. Brady had more than 1.1 million shares. His ex-wife Giselle only had about 680,000. So she had a little bit less of an investment. But we see a lot of big names here. There are trusts affiliated with, say, Peter Thiel, with Dan Oak, Dan Loeb. So a lot of the really big names in the industry were in FTX. And so you're getting a sense of just how many people were interested in this and how many people, you know, thought it was a great investment.
Were you surprised, Joanna, by any of the findings?
Well, Francine, I was a little bit surprised, to be honest, that Tom Brady had so many more shares than Giselle because they did do a deal kind of at the same time. And maybe that's related to advertising or something. But the difference in the amount of shares was pretty interesting. And then, of course, a little bit surprised at the extent to which you had somebody like Dan Loeb investing in it or the Peter Thiel vehicle, that sort of thing. So it's just interesting to see all these names there.
Thank you so much. Our senior crypto reporter there, Joanna Ossinger in Singapore. Now, coming up, strike season. Will UK ambulance workers head to the picket line to protest pay while French pension reforms spark anger? So we'll have plenty more on those two stories next. And this is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Welcome back to the Open, everyone. We're 42 minutes into the European trading day. The picture across the board is one of tepid gains. You can see European stocks gaining 0.1%, I guess. I mean, I don't want to call it too soon, Tom. I would say like smooth sailing, but I'm always wrong on this until we have the CPI print tomorrow.
I don't know, I like the tepid trading.
You like that?
Absolutely right. It's all
CFA level 5.
CFA level 5. There you go. Notch it down in your notebooks. Let's get back to the industrial action. Again, in the UK, but also France. Strikes in the UK and France in focus. Yes, Emmanuel Macron's plan to raise the minimum retirement age to, shock horror, 64 by 2030 has sparked anger, again, shock horror, among labour unions. They immediately called for protests and strikes against the reforms. Meanwhile, here in the UK, ambulance workers are holding a second strike today over real terms pay cuts suffered by NHS staff. For more, let's bring in Bloomberg's Caroline Cornat, who's been following this for us, and of course Lizzie Burden on all things UK. Caroline, let's start with you. What are the details then in this proposed pension reform? We knew this was coming, but it's central to Macron's agenda.
I don't know if it's a shocker for you, but definitely the end of the retirement at 62 years old in France. This is it. If you were born after 1961, you will have to work until you're 64. So this is, of course, the main feature of the reform presented by the Prime Minister, Elisabeth Borne, last night. There will also be some ending to those special exemptions that the public sector has got, including the rail sector, and there will be also a minimum pension of 1,200 euros a month for the future and the current pensioners. So that's about 2 million people currently. And this is very important because this is something that the Republicans wanted in order to give their support in Parliament. But if you look at the average age of retirement across the world, of course, France still has one of the lowest. For example, in the UK, you retire on average at around 63 or 64 already. And if you're in the US, it's around 65. And if you're in Japan, even though the system actually costs as much as in France in terms of spending, you actually retire, if you're in Japan, at around 67 or even 68. So clearly, this is the argument of Macron, and he wants to leave this legacy reform behind him.
Caroline, I Googled it. I mean, because I thought it was still 66 here in the UK, and what I love is that Google tells me you can usually work for as long as you want to. Thank you, Google. Caroline, what consequences could Macron's government face?
So the reaction of the unions was instant. They met last night, straight after the conference of Elisabeth Borne, and they announced the first day of strikes next week, next Thursday, January 19. All 8 unions will be involved, including the more moderate CFDT union, and that's the first because they didn't join the strikes back in 2019. So the far left, the Greens, will also join. It's unclear yet whether the far right of Marine Le Pen will join, but of course it will very much depend on how much of the general public descends on the streets, given that more than 2/3 of the French are opposed to raising the retirement age.
Of course, the proponents for this change would say it's all about demographics, it's about an aging population, and you can't push back against that would be the argument. Lizzie, let's bring you in at this point. It's a very different prospect when it comes to ambulance drivers here, the NHS. Pretty remarkable, on strike again today.
Yes, and their tensions remain incredibly high between the government and the unions. I was speaking to the boss of the GMB union on Bloomberg Radio just this morning. His members are involved in the ambulance drivers' strike, and he actually compared the anti-strike legislation that the government tabled yesterday to something Vladimir Putin would do in terms of curbing the right to strike. Now, there has been progress, let's be honest, in terms of the talks. The government is now considering backdating pay, so a compromise between, on the one hand, the union's demand and the government's refusal, on the other hand, to negotiate on pay for this financial year. The boss of the other union that's involved in these ambulance drivers' strikes, Unison, one of the bosses, said that there's a chink of light in that finally the government is talking about pay, even if there isn't a written offer on the table as yet. The question today is whether the opposition Labour leader Keir Starmer at Prime Minister's Questions at lunchtime is going to put the Prime Minister on the spot about strikes, because doing so could put himself into a difficult political corner.
So will the anti-strike law work, and would it even get through the House of Lords?
Yes, it would have difficulty in the Lords, it would have difficulty in the courts, and Labour has said that if it gets to power, it's going to repeal this bill upon taking office. So it may not see the light of day. But the argument from the government is that it wants to have minimum service levels to reduce the disruption of strikes in future. And it points, Caroline can correct me, but it points to the examples of France and Germany, where from the outside it looks to me as if their laws are less stringent, but proved more very controversial when they were first introduced 15 years ago, but actually now are proving quite effective. So really, in terms of the pay dispute, where we go from here, it does seem that the nurses are going to be the ones who can hold out the longest, because there's lots of public support for them, more than other unions who are striking, but also because their working conditions, aside from pay, are so tied up in the state of the health service, and its issues are so intractable given the ageing population.
Thank you so much to both of you, of course, Caroline Conan in Paris and Lizzie Burden here in London. Now let's get straight to the Bloomberg First Word News with Laura Wright. Hi, Laura.
Hi, Francine. The World Bank has slashed its growth forecast for most economies this year, warning that any new shocks could lead to a global recession. The lender estimates world GDP will grow 1.7% in 2023, about half the pace it projected in June. That would be the third worst performance in the last 30 years after the contractions of 2009 and 2020. Bloomberg has learned that Apple is planning to start using its own custom displays in mobile devices as early as next year. It's part of a sweeping effort to reduce its reliance on firms including Samsung and LG and bring more components in-house. Sources say it aims to begin by swapping out the display in the highest-end Apple Watches by the end of next year. Jay Powell has set out the limits of the Fed's role in promoting a greener economy, vowing it will not be a climate regulator. Speaking in Stockholm, the Fed chair says the US central bank will stick to its mandate of maintaining price stability. Powell says without explicit legislation, it would be inappropriate for the central bank to be a climate policymaker. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Laura Wright here in London. Thank you very much indeed. Now, coming up, Elon Musk, back in the headlines once again, plummeting personal fortune. Quite a hit. We got the details in today's Bloomberg Big Take. Can he ever become the world's richest man again? We'll bring you the details. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
Welcome back to the Open. 53 minutes into the European trading day. Happy Wednesday. Gains of 0.2% across European equities. Here in the UK, FTSE 100 up about 0.4. Basic Resources is part of that mix. FTSE, in terms of the futures, I should say, stateside, just edging down by about 0.1% on the S&P E-minis. Francine.
Now, let's take a look at some of the things to watch out for today. 9:30 a.m. UK time, the Bank of Italy will release its monthly statistics on banks and money. 12 p.m. we'll have industrial production data from Mexico. ECB Governing Council members from Austria and new member Croatia will also join the euro area. That joins the euro area on January 1st, speak in Vienna at the Euromoney CEE conference. And then a little bit later, Albertson and KB Home report earnings.
All right, we have a redhead crossing the terminal. Credit Suisse considering a 50% cut to its 2022 overall bonus pool. So that is a 50% cut to its overall bonus pool. Of course, this coming in the context of Credit Suisse and a lender that are having to significantly readjust its business in terms of all the challenges it has faced. This is a company, of course, and a bank that Francine knows very well indeed. Let me just briefly, before we bring Fan in, get you another line. Bonus pool, so may fall to about $1 billion, Francine, after a year of losses.
Yeah, which would make sense given the year they've had.
Yeah.
So if you look at the latest, this is a nice Bloomberg scoop by our people on the ground. We have two fantastic reporters, Miriam and Marion. And they basically say that if you look at the drastic cuts to variable compensation, they would be much deeper and maybe possibly last for longer than, for example, peers on Wall Street such as JP Morgan and Citigroup. If you look at Goldman Sachs, but also JP Morgan, given the year they've had saying, look, they're going to cut bonuses, then this, I don't know how much of a surprise this is, and in fact, the share price is gaining 1%.
So the share price up on the back of this news, and as you say, will employees really be that surprised? But it has done, and we'll come to that question of what it does to employee retention, given they've faced that challenge as well. Some of their senior bankers leaving that bank. So that's the headline in terms of the redhead for Credit Suisse. Let's briefly get to what's happening with Elon Musk then, talking of falling fortunes. Elon Musk might never be able to reclaim his title as the world's richest man with the ongoing Twitter drama and the Tesla stock tanking. His net worth has fallen more than $200 billion from its peak on our Bloomberg Billionaires Index. Today, Bloomberg's Big Take examines that plummeting personal fortune. We're joined by Bloomberg Wealth reporter Anders Mellon. Anders, walk us through how someone can possibly lose $200 billion in a single year.
I think it's a two-part answer. So in late 2021, we saw equity starting to come off their highs. And then in February of 2022, you had the Russian invasion of Ukraine, which had large effects on the global economy, including rising inflation, interest rates going up, and that tanked a lot of stocks broadly, but particularly so shares that did really well during the pandemic, including Tesla. And then you have Elon's acquisition of Twitter, which at first seemed like a ploy, and then it was actually serious, and that now is coming with actual financial consequences. It was expensive. It's financially restrained him in a way that he hasn't been before. And it's also made a lot of Tesla investors concerned that he's spending a lot of time on something else than Tesla. And I think you're seeing reactions on that in the share price, at least now in the short term.
Anders, thanks so much. Anders Mellon there joining us. Of course, a wonderful, great story looking at all the ups and downs of one of the most well-known men in the world. Now, if you like to read more on this, of course, just type NI Big Take or press go on your Bloomberg terminal or log into Bloomberg.com. We'll have plenty more on the markets shortly. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Bulls on the front foot for now. European stocks muted as markets look for inflation moderation. Jeffrey Gundlach says look to bonds rather than the Fed for clues on interest rates. Homegrown Apple now, the tech giant plans to start using its own custom displays in mobile devices as early as next year, dealing a blow to Samsung and LG. And slashed by half, Credit Suisse considers a cut to its bonus pool by 2022 by a whopping 50%, and shares are up. Now, first thing is first, we do also have some breaking news on Credit Suisse that we just brought to you, so we'll go straight to Zurich. But the market, let's have a quick roundup of what we're seeing right now. 0.3% for the Stocks Europe 600. Traders, I think, were expecting some kind of carrot from Jay Powell to figure out his thinking on inflation monetary policy yesterday. We did not get that. It was more actually cerebral on how central banks need to look at climate change. S&P futures pretty much unchanged. I have to say all of this will be moved by what we have in terms of that CPI print tomorrow in the U.S. Now, Credit Suisse is considering cutting the bonus pool for 2022 by about half, and that's according to people familiar with the matter. Now, for more on all of this, we're joined by our Bloomberg finance reporter who helped break this story. She is Marion Haftofmeyer. Marion, thank you for joining us. So if you look at bonus pools across the world, especially on Wall Street, they're going to be down. Credit Suisse deeper than the others. How big of a surprise is this, given the terrible year they've had?
We're not particularly surprised at all, actually. I mean, as you mentioned, across Wall Street, it's been a rough year. Deal making is down, but Credit Suisse's situation is a little bit more severe than you could say some of its peers are in, because it's had just a difficult year. It's in the middle of restructuring. It had a $4 billion capital raise. And it's trying to sell off its investment bank. And on top of that, we saw ridiculous amounts of outflows in its wealth management division last quarter. So, you know, all of that's playing into just how much they can pay their bankers and the bonuses.
Yeah, and Marion, I guess the question is, can they retain the top talent or the people that they want to keep? Because we've seen also a number of high-profile defections because, I guess, of the toxicity of the brand. So do we think that the people that they want to retain will still be paid a good bonus?
So that's the tricky part here, is that they have been juggling this fine line between paying up and retaining the bankers they want to retain in order to do that turnaround, and particularly for the Credit Suisse First Boston branding. but at the same time having to negotiate the fact that they just don't have the money to be paying everyone. So it's a bit rough. I think there is a bit of cherry picking as to which top bankers are getting these retention bonuses. So they don't have to worry about this 50% cut in the bonus pool because they've had some off-cycle bonus, and so it's fine for them. For the rest of the people, it's very discouraging. And, you know, we have heard that there are many people who won't get a bonus at all.
Yeah, and this, of course, will be a blow to a lot of people that have or haven't been told, or certainly that are watching this program. Marion, this is a difficult question because I know 2022 really brought up some surprises on Credit Suisse, but what's 2023 going to be like for them?
Hopefully quieter, but the main theme that we're going to be looking at for 2023 will be how exactly they carve out this investment bank. We broke some news earlier this week about how they are buying Michael Klein's investment boutique to be part of the Credit Suisse First Boston branding, and he's a big name, so hopefully that'll attract some talent there. And so hopefully we'll get a bit more clarity on how they're going to structure that partnership, if they're going to be spinning it off, who are the anchor investors, and what that will look like for the employees who are still figuring out what the bank they work for is going to look like in next year.
Marion, as always, thank you so much. Marion Halftermeyer there, our lead reporter on some of the Swiss banks. Now, stocks in Asia climbing and trading today after, amid upbeat sentiment over China's economic reopening. That's as traders are betting that U.S. inflation data due out tomorrow will show further softening. So we're joined now by Andrew Pease, Global Head of Investment Strategy at Russell Investments, and Mary Nicola, Global Multi-Asset Portfolio Manager at PineBridge Investments. So thank you both for coming on today. Andrew, let's kick off with you. When you look at inflation expectations and the risk of a recession, where do markets end up by the end of the year?
Well, I think it's going to be a challenging year for equity markets. It may be we have a soft period during the year, but we get some gains back, and I think that's the theme. A recession still seems likely. I know we've started the year on an optimistic footing, but when I look at things like earnings expectations, they're still not consistent with the fact that the US is going to have a decent slowdown, potentially a mild recession this year. So I think that's going to be the major headwind that equity markets have to contend with as we go through 2023.
Mary, what do you see the biggest pitfall? And good morning to you as well. Where are you seeing the biggest pitfalls for this year?
You know, one of the key things that while everyone's focused on the Fed and where they're going to stop hiking rates, for us, one of the key things to focus on as well is continued quantitative tightening. So even after the Fed is going to stop hiking, you still have a clear headwind coming through from continuous quantitative tightening and the shrinking of the balance sheet. And that, we think, is going to be a continued headwind for equity markets and broader markets in general.
Mary, what does that mean for opportunities that you see across the board? Again, is there danger, and we had this warning from JP Morgan Chief Executive Jamie Dimon yesterday, that he thinks, given all of the pitfalls right now and the poly crises we could see, the Fed could keep on raising rates beyond 5%?
For us, we're pretty cautious on the outlook. So one of the key things that we've been quite underweight equities for some time. But we think there's some opportunities, so we've been quite selective. So within U.S. Equities, one of the things we've been focused on is U.S. quality, so higher quality names, some companies that are going to be able to withstand some of the key challenges that are coming through. Another one that we like is Chinese equities. Chinese equities, especially with the reopening and the rapid changes in the zero COVID policy, we think there's some upside there. And for example, for us, valuations are quite attractive in China equities. Another thing, and Andrew touched upon this, was the fact that because we do see a recession coming through in the U.S., one of the things that we do find attractive is the back end of U.S. Treasuries. So think the 30-year, we find good value there.
Andrew, where do you see the biggest value?
Well, I think the duration call is probably worthwhile. I think the steepener is probably something which is realistic to think about right now. In terms of finding where value is right now, it's been challenging for quite a while. It's hard when you look across equities to find anything that's much better than fair value, but a lot's going to depend on what happens to Treasury yields. And if we do see Treasury yields start to come down as we go through the year, then obviously that brings some value back into equity markets.
Mary, one of the big winners, of course, last year was value investing relative to growth investing. Is that one of the themes that will continue this year?
You know, it hasn't been for us, and obviously there was especially a violent shift that we saw last year from growth into value, especially as rates rose. But we do find a lot of sectors within value equities quite expensive. So from a valuation perspective, it's not that attractive to us. So we continue to try and find pockets. Another one that we're looking at is pockets within new energy. So especially with what's happening in Russia and Ukraine, obviously, some of the key things that is going to be is that governments are moving forward a lot of their objectives in terms of carbon neutrality. So one of the key things that we've had is an allocation into new energy. So think of a lot of the traditional new energy companies like wind and solar, but also utility companies that are actually transitioning to new energy that we see as quite attractive.
So, Andrew, to Mary's good point, and I'll also ask about this, energy, though, last year was really the outstanding sector, outpacing everything else by a pretty wide margin. What happens in 2023 with energy?
Yeah, it's a great question, isn't it? It's going to determine a lot. And I think one of the surprises of early 2023 has been how much energy prices have stayed subdued, particularly with oil prices down under $80 a barrel, and certainly what we've seen with natural gas prices. A big question is going to be around geopolitics, and a big question is also going to be around what happens with the Russia-Ukraine war and how much does the China reopening start to push up commodity demand as well. So I don't think we're likely to see an energy shock. We know that energy markets, particularly oil markets, are pretty tight right now, but I also think that OPEC is going to be managing the supply side quite closely as well. So I wouldn't expect to see a lot of downside from oil prices here, and there may be some upside when the Chinese reopening comes through, but I wouldn't imagine that we're going to have anything like the energy price shock that we saw in 2022.
Mary, if you look at oil and gas prices rolling over in the last couple of months, how do you play that story?
You know, actually, one of the key things, the key strategies that we've had for quite some time is playing on the backwardation within the commodity curve. And that was across all different commodities. It wasn't specific for any particular one. But as we've seen the backwardation starting to normalize, we've actually taken that off. And we do see spot prices likely to come up as a result of the reopening in China. While we don't think that the China reopening is going to be based on what you see as your traditional reopening where it's more investment-led growth, we do think that domestic demand is going to play a bigger role. And we saw that with the Economic Working Committee in December, where they were focused more on domestic demand and how to improve domestic demand in China. So yes, spot prices is likely to come up, and we don't see the backwardation as attractive anymore.
Andrew, when you look back to 2022, of course, we saw some pretty, tough valuations or falling valuations in certain sectors, but earnings seem to be holding up. What are you expecting in terms of earnings for the next couple of quarters?
Yeah, earnings are going to be the big story, and I think that's where really if we go, like right now, we're in this phase in markets where softish news is being applauded and markets are going up because they're thinking that makes the Fed less likely to act, and people are looking for the soft landing. But when we actually start to see that data start to weaken, particularly the labour market data, and as the earnings numbers, and they're starting to get revised down lower, but as those earnings numbers start to turn negative, which they should if we are heading towards at least a mild recession in the US, I think that's going to be one of the stories. And can we withstand, can multiples withstand the earnings downgrade, I think is going to be the story of 2023. So from where we are, there's not a lot of upside for equity markets in general, particularly the S&P 500, and there certainly could be some downside if we do get that earnings shock heading through, say, the middle of the year.
Yeah, Mary, do you agree with that?
Yeah, actually, we have a very, very similar view in the sense that we think that earnings are going to start disappointing and disappointing even more. We haven't seen that yet come through. And we think the next few quarters are going to start showing that slowdown that we've been expecting, in terms of hinting at a recession in the US and even in broader Western markets. So we're expecting earnings to continue to disappoint even more over the next few quarters. And rather than being better than feared, we're going to just see outright disappointment.
Mary, how do you play the reopening of China?
So we've actually had an allocation in China equities, so both China A and China H. We see value there. We see valuations quite attractive in China. And also, you know, we're going to start seeing that reopening really come through. It's going to be bumpy. There's no question. So the real thing is, you know, being able to withstand that, especially within the first few months. We see it already in terms of just how things are playing out, in terms of seeing a spike in COVID cases within China and some of the data coming through. And it's going to be bumpy, but we do think that things are going to start playing out and that things are going to improve in China, especially over the next few months, and really benefiting from that reopening. So which is why we've had an allocation both in China A and in China H equities.
Andrew, how do you play China?
Yeah, so we run a manager process. So what we're seeing is the alpha opportunity in China looks very strong right now. Our managers are seeing more opportunities they have universally than we can recall them ever seeing before. The challenge with China is the beta. What happened to the Chinese economy? There's a great story building once we get past the COVID spike about the reopening, but the property market is still a problem. The government is already quite stretched fiscally, and it's a matter of they're talking about potentially easing those red lines on property developers, but can they get the type of property market recovery that's required? And the consensus has really pushed up its expectations for Chinese growth this year up to around about 5%. And I think it's going to be a bit of a challenge for them to get there. I think, yes, China's going to have a better 2023 than 2022, but I think that we have to be realistic about just how large a headwind that property sector is.
Thank you both for joining us. Terrific conversation getting us started for 2023. Of course, Andrew Pease, and well, we'll have plenty more from Mary Nicola as well. Now, coming up, we have plenty more on investment. Court documents, an FTX bankruptcy case reveal the celebrity shareholders set for wipeout. We'll have all of the details later, and this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The World Bank has slashed its growth forecast for most economies this year, warning that any new shocks could lead to a global recession. The lender estimates world GDP will grow 1.7% in 2023, about half the pace it's projected in June. That would be the third worst performance in the last 30 years after the contractions of 2009 and also 2020. Now, Bloomberg has learned that Apple is planning to start using its own custom displays in mobile devices as early as next year. It's part of a sweeping effort to reduce its reliance on firms including Samsung and LG and bring more components in-house. Sources say it aims to begin by swapping out the display in the highest-end Apple Watches by the end of next year. Jay Powell has set out the limits of the Fed's role in promoting a greener economy, vowing it will not be a climate regulator. Speaking in Stockholm, the Fed chair says the U.S. central bank will stick to its mandate of maintaining price stability. Powell says without explicit legislation, it would be inappropriate for the central bank to be a climate policymaker. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Leanne Gerrans here in London. Coming up, strike season. UK ambulance workers head to the picket line to protest pay. We'll have plenty more on that next, and this is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Let's talk strikes. And UK ambulance workers are holding a second walkout today over real-term pay cuts offered by NHS staff. Now, that comes as the government plans new laws to limit disruption from future strikes. Now, for more on all of this, we're joined by our UK reporter, Lizzie Burden. Lizzie, good morning. I mean, it is, amazing that this has been lasting for quite some weeks. Today, it's, of course, ambulance workers. Are there any signs of progress in the talks?
Well, actually, the tensions are really high between the government and the unions. I was speaking to the boss of the GMB union, which is involved in the ambulance drivers' strike today, and he compared the anti-strike legislation that the government tabled yesterday to something that a dictator would do. He mentioned Vladimir Putin because, of course, it's going to curb workers' right to strike. But there has been some good news, and it's been reported by our reporters, that the government is considering backdating pay, and that would offer some sort of compromise between the union's demand and the government's refusal to negotiate on pay for this financial year. So the other union that's involved in the ambulance drivers' strike today, Unison, described it as a chink of light, that finally they're talking about pay, even if there isn't a written offer on the table. But what I think is going to be interesting today is at Prime Minister's questions. Yep. Does Keir Starmer, the Labour leader, actually go there on strikes when actually it's a pretty difficult position for Labour as well?
So, Lizzie, if you look at the anti-strike law, I mean, would it even work, or is it just a negotiation position? Does it get through?
Well, it's going to take ages to get through if it does. It's going to face opposition in the House of Lords, in the courts, and if it passes, Keir Starmer has said that he would repeal it upon entering office, which harks back to the 1970s industrial relations legislation as well. The thing that the government keeps hammering home in the past 24 hours is that you've got similar legislation to this in Europe, in France and Germany, and it's less stringent and it's quite effective in providing a minimum level of service. That's what the government wants. But in terms of where we go from here on the negotiations, it seems to me, if I were going to bet, that no one placed a bet on this.
I was going to say, we'll put a poll on social media. You can bet there.
The nurses are going to be able to hold out the longest because they've got the public with them, and their problems in terms of working conditions are just so tied up in the health services problems more generally. And when we've got an aging population, they seem to be really intractable.
Yeah, I don't write to my IMP often, but I did write actually on this. Yeah, during the COVID, when we were all clapping at 8 p.m. It feels like a long time ago. Lizzie, thank you so much. Lizzie Burden there with the very latest on these strikes. Now, we'll also be covering all things UK every week, Thursdays at 9:30 a.m. in our half-an-hour special. Coming up, the World Economic Forum Managing Director, Sadia Zahidi, on the WEF's Global Risks Report 2023. That interview is next, and this is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can
spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Here, your top story, bulls on the front foot for now. European stocks edge higher as markets look for inflation moderation, while Jeffrey Gundlach says look to bonds rather than the Fed for clues on interest rates. Homegrown Apple, the tech giant, plans to start using its own custom displays in mobile devices as early as next year, dealing a blow to Samsung and LG. And slashed by half, Credit Suisse considers a cut to its bonus pool for 2022 by a whopping 50%. Shares trade higher. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the World Economic Forum has published its 2023 Global Risk Report ahead of Davos next week. The cost of living crisis tops the list for the next 2 years, while environmental risks will dominate over the next decade. Well, I spoke to Sadia Zahidi, Managing Director and Partner for the World Economic Forum, about the risks we're also facing right now.
It is playing out to be one. We have this risk of polycrises emerging because so many things are happening at once. There's the currently unfolding risks, and that's where we looked at sort of year zero. Where are things today? And it's very clear, energy crisis, food crisis, top of the list. Then we look 2 years out, and the cost of living crisis is still expected to be the #1 risk at that time. And I think it's because people are not really expecting to come out of this current situation very quickly. And then there's the 10-year risks, and 6 out of the top 10 all about climate and the environment.
Is there a danger that we don't fix the climate and the environment because it's going to be so ugly in the next 2 years?
So this is exactly what we're pointing out, that leaders can no longer sort of say, let's address the short term first and then we'll look at the long term, because this is it. The entire time horizon has to shift. And if we're going to look for solutions, there have to be some synergistic solutions that, for example, look at climate and food at the same time, that look at agriculture and energy at the same time. If we don't do that, we don't quite come out of either the societal crisis or the environmental ones.
Sonia, how much have these top 10 risks actually changed in the last 3 to 4 years?
So it's very clear that climate is actually just continuing to grow in severity, and that's really not changing in the 10-year time frame. But in the shorter term, economic risks, societal risks are at the very top. The last time inflation was at the top, or last time inequality was at the top, was more than 10 years ago. We're talking about at the time of the global financial crisis. That's when these concerns were last there. So this is all fully back at the moment, and I think this sort of crunch time that leaders are facing, they're potentially unprepared for. Very few leaders in today's generation have been through these kind of more traditional risks around food and energy, while at the same time battling what's coming up in terms of debt, what's coming up in terms of climate. So we're going to need a sort of new type of leadership that is much more agile and that can have the short and the long-term time frame.
Are chief executives and leaders actually underestimating the new economic era that we'll see in the next couple of decades?
You know, every day there's sort of a new prediction around, are we heading into a recession? Are we not heading into a recession? I think the main point here is we have a few tools that leaders are continuing to use, but those tools then have repercussions. As interest rates get higher, there's also a lot of concern around what's happening in emerging markets. We could be entering a vicious cycle. And so there has to be some medium-term thinking, some thinking about the kinds of investments that are non-inflationary, but will put in place the basic resilience and the shift in our sort of economies and economic structures, especially towards more green.
Well, that was Sadia Zahidi, World Economic Forum Managing Director about global risks. Of course, they published their global risk report today. Now, billionaire New England Patriots owner Robert Kraft and star NFL quarterback Tom Brady are among those sharing in the pain of FTX's sudden collapse. Bankruptcy court documents reveal Brady alone owns more than 1 million shares, which are now assumed to be practically worthless. Well, joining us now is Ana Herrera, Bloomberg's senior crypto editor. Ana, thank you for joining me. We were all poring over this yesterday because we had been waiting to have some kind of filing on who lost the most money. Do we have any idea of how much these shares were worth when they bought them?
We don't know how much he lost in terms of amount of money. And this is interesting because we found out who some of the equity shareholders were. Obviously, there was such a complex organizations with so many investors, but we still don't know who the biggest creditors are, which is a thing that needs to remain. It's interesting, we found out, as you mentioned, sort of Tom Brady's holdings, which were quite big, but we knew he was an investor. He was in their ads. And also goes to show how, mainstream FTX had become and how much it contributed to getting regular investors on board. I was speaking to someone who, said I was a big fan of sports, and you saw all these big athletes, and it made me think it was a great safe place, and it was legitimized by these people.
So, Anna, when you look at those, what surprised you the most? Who was invested in, or the amount of people?
The amount of people, so many investors. There were lots of, family offices as well. So it goes to show, regular investors lost money, but also people that were a bit more experienced that has an opportunity to buy equity in the company, as well as the big funds. SoftBank was an investor, Tiger Global. They also kind of lost money.
So the other story, of course, Coinbase cutting jobs. Yeah. The winter was rough. What's the rest of the year going to be like?
Yeah, it seems like we're getting into this. We were discussing this yesterday. We're getting into the second year, I think, of the winter. Coinbase, of course, has been through other winters before, so they're not a newbie to challenges. But what they were saying is now you have a crypto winter coupled with a recession broadly, or just tougher macroeconomic times. So they've had to cut again. It's the second time they cut. It's interesting because they're public, so you get to see a bit more behind the scenes of what's happening. With other exchanges, it's a bit harder, and they might not talk about the layoffs, or they might, not talk about their financials as transparently.
So, Anna, overall, what challenges? There are many challenges, but if you look at the exchanges, are there any specific challenges that we really need to watch out for this year?
Obviously, lower trading volumes are a problem because they make money with fees. So if that keeps going on, then they have lower revenues. We also have discussed the issues around transparency of reserves. Do they have enough money? We've had exchange runs before. Binance had a rush to withdraw. Now things have stabilized, but it's one thing to watch, right? If people lose confidence in an exchange and they suddenly rush to withdraw, will their money be there, or will we have another FTX type scenario?
So is this the year? we talk about valuation leverage, but this was something different. Yeah. What does it mean for crypto this year?
Yeah, we have to see if, the players that came in, the big money stays there and they hold, and maybe Bitcoin keeps it. It's kept a fairly stable price, much lower than a year ago, but it's still fairly stable. If that maintains, if the industry likes to say we're building, but a big question is building what and what money now, right? Because I guess many of them are in saving mode, as we see with Coinbase, cost saving. So it'll be interesting to see what happens for sure.
Anna, thanks so much, as always. Ana Herrera there, Bloomberg senior crypto editor. Now, coming up, we get the outlook for M&A with JP Morgan's Dwayne Lysite. He's optimistic about the next 12 months, so we'll ask him why. And this is Bloomberg.
they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So M&A volumes fell materially in 2022, but we're well ahead of averages for the last 10 years, providing optimism as we start the year. Well, that's the view of our next guest. He's Dwayne Lyside. He is co-head of EMEA M&A at JP Morgan. Thank you, Dwayne, for joining us. I mean, you always make us smart on what you're expecting the year to be, and you're quite optimistic about the next 12 months. Why?
Now, first of all, thank you for having me on. And we are cautiously optimistic, is what I would say. I think when you look at last year, down 36% globally, down 36% in EMEA. But actually, when you look at the long-term trend, 8% ahead globally of the average and 2% in EMEA. So putting the year in context, 2022 that is, it was a kind of an average year, not too hot, not too cold. In terms of this year, I think we see that continuing. I think it's going to be a relatively average year, probably flat overall, and probably a year of two halves. A bit like last year in terms of the next 6 months could be tricky as things settle down, particularly equity valuations, the debt markets coming back, equity markets coming back to support those M&A transactions. And then we're hoping that the latter part of the year, latter 6 months, say, will be kind of stronger in terms of announcements and general momentum. So that's how we see.
Dwayne, so we're going to, I don't know how long you're expecting interest rates to be higher, but this is a new economic era. And we could see this for the next decade. How much does this impact actually just the level of interest rate and leverage, M&A and everything you have in the pipeline?
I think undoubtedly there's a transition period as, frankly, people get used to the higher rates, the lack of availability maybe of debt. But the debt markets, they'll come back. And when we look back over a 20-year period, when we saw interest rates at these levels, the actual levels and volume put through each year were equivalent to some of the best years we've ever had, 2006, 2007, etc. So we're not overly perturbed. And to put it in context, the likes of a 2006, 2007 type year was well ahead of the strongest year we've had very recently, which was, as you know, was 2021. So again, cautiously optimistic, not getting too far ahead of ourselves, but we see things coming back reasonably strongly.
What are the specific sectors that you're most interested in? I know last year, overall, it was tech that really dominated it, and in Europe, it was diversified industries.
Exactly, and I think if we look at EMEA specifically, I think diversified, given rotation of assets, consolidation, general fragmentation, we probably see that as one of the leading sectors. There's a lot going on in terms of energy transition, which I think benefits diversified industries, but obviously the energy sector, as large as it is and wide as it is.
And that's despite the war in Ukraine.
I think so. And I think in some ways, because of it, that actually people are looking at other opportunities and ways to generate that energy and provide to the customers. I think other sectors, your point on tech, I think globally that is certainly going to be one of the leading sectors, same in EMEA. And it is really about the tech evolution that is occurring, the enabling of tech within older economy type of industries, diversified particularly. So we see that theme generally across the market. The other thing I'd add would be that sectors maybe that haven't been as busy in recent years, maybe a healthcare, a FIG, they tend to have a pop-up year every 2, 3, 4 years, and we probably see 1 or 2 of those coming back reasonably strongly for all the reasons you know, and that is people seeking opportunities for growth, consolidation, and costs.
In your many years' experience, of course, as a banker in M&A, is there good M&A compared to bad M&A? So the M&A that you either do out of desperation or just because it looks attractive, and how do you not fall in that category when you're trying to make a deal?
Well, I think there is a general caution around at the moment. So I think people are extra sensitive to exactly that point. So we're hoping that it is careful, well thought out, strategically led M&A that occurs. There's always M&A which you, in hindsight, wish you maybe hadn't done, the deal you didn't do, but that is with every cycle. And a lot of it often is not necessarily the deal itself, but the implementation afterwards. And things change, environments change, etc., that make that implementation trickier. But we're hoping for good M&A.
Well, we are. Everyone's hoping for good M&A, especially the people involved. When you look at the different countries, so is the UK, again, are there opportunities in the UK because of cheaper valuations, because of weakness in pound, compared to, say, a France or a Germany?
Well, I think I'd answer that in 2 ways. I think we expect the likes of the UK to be a leading M&A generator in 2023. The big economies of France and Germany are never going to be far behind. They probably fell further back last year compared to the likes of the UK, despite the economic turmoil that we saw. So UK we expect to be strong, other leading economies as well. And I think the cross-border point, driven in part by currencies, never a reason to do a deal, a strong currency, but it will help people to get the deals done, make the financials work. And that cross-border element we are watching carefully. Last year was a slightly muted cross-border year. This year we expect it to be stronger. Okay, every year someone comes on and says, this is the year where we're going to see activist shareholders in Europe, much like we do in the US. Yep. Is this, I mean, is there attractiveness just because it's a smaller capital pool in Europe? Or, and how does that change? Are we going to see big investors trying to shake things up in Europe? Well, I think we've seen 1 or 2 of them in recent days, as you know. Looking at it, last year, definitely more muted. Yep. We had 77 campaigns in EMEA publicly versus 98 in the year before. We think a lot of the activist campaigns were sitting in the background. A lot of work being done. Yep. A lot of it in private. We expect more of that to come to the foreground in 2023. So I think the prediction, if you like, would be more public activism occurring for some of the reasons you're mentioning in terms of particularly driving equity valuations, maybe forcing companies to really think about their structure, what should be spun out, maybe sold off, or indeed consolidation opportunities that management need to get on with.
I mean, is this like a chief executive's worst nightmare? Someone could, buying shares and thinking they can do a better job. This is like backseat driving.
It is definitely tough for management teams, but often management teams are actually quite well prepared for it, and they recognize that actually activists, they are a form of investor, which you listen to, you engage with. Hopefully there's something to be shared and gained on both sides, but at the end of the day, focusing on the strategy and the performance and the delivery to shareholders.
All right, Dwayne, thank you so much for joining us. Dwayne Lyside, they're co-head of EMEA M&A at JP Morgan. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gehrens. Hi, Leanne.
Hi, Francine. Bloomberg has learned Credit Suisse is considering cutting the bonus pool for 2022 by about half, capping a grim year for the bank. We understand the Swiss lender is set to make even more drastic reductions to variable compensation after the 32% cut for the previous year. Now, Bernard Arnault has appointed his daughter Delphine to run LVMH's second biggest brand, Dior. This as a 73-year-old billionaire continues to elevate his children to key posts in his luxury empire, having recently given his eldest son a wider role within the business. Now, French unions have called for a day of strikes next week as an initial response to a government plan to gradually raise the minimum retirement age from 62 to 64 by 2030. President Emmanuel Macron argues a change is needed to boost low employment rates among older people and to keep a cap on rising costs for the government. Bloomberg has learned that Apple is planning to start using its own custom displays in mobile devices as early early as next year. It's part of a sweeping effort to reduce its reliance on firms including Samsung and LG and bring more components in-house. Sources say it aims to begin by swapping out the display in the highest-end Apple Watches by the end of next year. A White House official says President Joe Biden has asked Treasury Secretary Janet Yellen to stay in her post. We are told the U.S. president made the request, which he did accept in mid-December. The move ensures stability ahead of another upcoming fight in Congress over raising the debt ceiling. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, coming up, Elon Musk's plummeting personal fortune. That's today's Bloomberg Big Take, so we'll have that next. And this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Elon Musk might never be able to reclaim his title as the world's richest man. With the ongoing Twitter drama and Tesla stock tanking, his net worth has fallen more than $200 billion from its peak on our Billionaires Index. Now, today's Bloomberg Big Take examines plummeting personal fortune for him. Now, for more on all of this, we're joined by our Bloomberg wealth reporter, Anders Mellon. Anders, thank you for joining us. So first of all, I mean, it is pretty incredible that he lost more than $200 billion in a year, but we've been following his trials and tribulations very closely. When you look at the trajectory, what's the most surprising?
I mean, the most surprising is the sheer amounts involved. 200 billion is just a staggering amount of money for anybody to lose. And to lose in such a short period of time. It was just, I mean, Tesla shares were at a high just in late 2021 when the equity markets generally were quite buoyant. And then things started going downhill first slowly and then rather quickly once Russia invaded Ukraine and with the
larger effects that had on the global economy. And then you put on top of that Musk's acquisition of Twitter, which at first looked like a ploy and then was serious and has ended up having actual consequences for him. It's restrained him financially in a way that he hasn't been in the past. And it's also taking time, many are concerned, away from his duties at Tesla. And I think that is having an effect on the share price, at least in the short term, if you look at what some big investors are saying.
Yeah, so Anders, how did Tesla actually help Musk be the richest person in the world?
I'm sorry, can you repeat the question?
So how did Tesla help Musk become so rich?
So it harks back to a couple of things. First off, he got 3 rather large compensation packages over the last 14 years at Tesla. They've really built his stake in the company. They've also served as a really great marketing vehicle to sort of set the path for the company. These packages have been really audacious, really large, and really just bold in their how they were formed. And that has led people to really adhere to Elon and see that Tesla is a company that's pushing for things that other companies might not do. And that's helped rally a lot of investors around the company, which has driven up the share price. And that's benefited Musk in that since his stake has grown, and both in size and in value, he's been able to take out loans backed by that stake and invest in other ventures that he's involved in, like SpaceX, like Neuralink, like the Boring Company.
So, Anders, what's the deal with his Tesla-backed loan now that the share price is down? What happens next?
We don't know the precise details. We do know that he, over the years, has backed quite a significant share of his Tesla stake as security for margin loans. We don't know how much margin loans he's been taking out over the years, but it's fair to assume, I think, that he's been taking out quite substantial amounts to fund his other ventures. And that, of course, has led to questions whenever Tesla share prices dropped. Does he have loans to such an extent that he will get a margin call? And there's been more questions raised about that this year. And what we have seen concurrently with the share price going down is that Musk, who historically has held on very tightly to his Tesla shares, has actually sold off as much as 40 billion now over the last 14, 15 months of Tesla stock. And that leads some to believe that he had to make at least some of those sales in order to cover for the loan that he'd taken out previously.
All right, thank you so much, Anders Mellin there with the very latest on Tesla. And if you want more on the big take, just go into NI Big Take. The picture is Credit Suisse up 1.5%. It's considering cutting the bonus pool for 2022 by about half. This is a Bloomberg scoop, and it's according to people familiar with the matter. Now, the Swiss lender, we understand, is set to make even more drastic cuts to variable compensation after the decline we saw in 2021. Bloomberg Surveillance Early Edition continues in the next hour, and this is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site, whereas this we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
This is Bloomberg.
I think that the tools that we have work. I think there's nothing wrong with our mandates.
That's what the Fed, the ECB, and all central banks are facing, which is, should we do more, should we do less?
What the Fed is trying to say very clearly is, you guys who are expecting a rate cut later this year, forget about it.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Fixed income mogul Jeffrey Gundlach says if you want to know where interest rates are headed, don't listen to the Fed. Instead, he says, listen to the bond market. Inflation in the Eurozone is still near an all-time high, but consumer expectations about higher prices are fading back to their long-term normal. And Apple wants to bring more components in-house. It will start using its own screens for iPhones and Apple Watches in a big blow to Samsung. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines. Kaylee Lines, in fact, on assignment today. Matt Miller with me, though, in New York. And Matt, European equity markets getting a bit of a boost early on this morning as the US futures picture starts to look more positive. Really, we're waiting for the inflation print, though, this week.
Yeah, we are, but there is more optimism on inflation, and that's why you see a slight lift to markets. Check out what's going on in Asia. We have the MSCI Asia Pacific Index up about 0.5%, as well as the Hang Seng, the Nikkei in Japan, up more than 1%. So Asian markets are boosted. We do see the yen right now at 132.5 per dollar. And in terms of what we see in U.S. markets, futures here are up as well. Not quite as much as you saw the cash trade in Asia, so the gains on U.S. futures, I think, are slightly less. Let's change the board, and I can be proved right or wrong. Survey says, yes, up 0.2% on the S&P, so not huge gains, but there is that optimism. Again, it's coming out of Europe, not here. And if you listen to, I guess, Jeff Gundlach, that maybe adds to the optimism, plus adding to the risk on feel is the fact that yields are coming down right now about 5 basis points to 356, 357 on the 10-year. That offers less competition to dividend yields on the S&P 500, earnings yield on the S&P 500. NYMEX crude right now, a little changed up 0.4% or 30 cents a barrel to 75.42. And Bitcoin is, well, it's down a little bit, but it's up compared to where we saw it yesterday and compared to where we saw it last month. So it was stuck for so long in that $16,000 range, and right now we're up at 17,500. Anna, what do you see in Europe?
Yeah, well, Europe does look positive, Matt, then. A little more positive than it was an hour ago. We're up by around 0.7% on the CAC 40, the FTSE 100, the DAX up around 0.8%. Pretty broad-based, this rally across European equity markets. There do seem to be a lot of voices pretty optimistic about European assets right now. Is that because of growth out of China and the impulse back into Europe, despite what that could do to higher commodity prices? Or is it about the inflation outlook, the achievements in bringing inflation down, and the lack of persistence in inflation expectations? We'll get more on that in a moment. This is the retail sector today, one of the sectors doing well, up by 1.8%. We've actually had a mixed reports card out from the retailers today here, Matt, but Sainsbury's to the downside, but JD Sports moves higher, and it seems to be that sentiment that's lifting the sector as a whole as we look ahead to a number of corporates in that sector reporting later on this week. Direct Line Insurance, it is, as the name suggests, an insurance business, and the story goes like this. The weather was cold in December. That resulted in more claims for things like burst pipes and other such matters, and that meant the company said this morning they're not going to pay their final dividend. And that didn't go down too well with investors. That stock down by 29% in today's session, just underlining what happens if those expectations are not managed carefully, I suppose. The French 10-year yield, I put this in, but it could have been the German, it could have been Italian, or even UK yields, because we're seeing a very similar pattern to what we're seeing in treasuries this morning. So we're seeing buying of fixed income. We heard Jeffrey Gundlach talking about buying fixed income products. We've heard Jupiter in London talking about buying fixed income products, and we see yields coming down. So here's the French expression of that. And I put the copper price in. It is, this is, well, above $9,000 a ton. That's the important point. For the first time since June, it seems it's the growth story, the reopening story out of China is helping to lift metals, even if it's not helping to lift oil prices, Matt.
All right, well, let's hear more from that West Coast bond guru. Jeffrey Gundlach says, if investors want to know where interest rates are headed, don't pay attention to the Federal Reserve. Instead, he says investors should look at the bond market.
The Fed funds implied rate by the yield curve, the Treasury yield curve, has really become remarkable, where we see that the bond market pricing shows that the Fed is not going to make it to 5%. They're going to make it just under 5% by May or June.
Bloomberg's Danny Berger joins us for more. So, Danny, what is the bond market telling us, and how does this all play out?
Well, it would just so happen, Matt, that I have a chart in front of me that shows what we're pricing in. So you have the Fed, the median projection from their latest dots is 5.1 for a terminal rate, but the market is pricing in 4.9%. The bigger disconnect probably is what happens after that. The Fed has continued to say that they're probably going to hold around that level while the bond market starts to cut. Now, it's not just Jeffrey Gundlach that's saying that, obviously, because people are pricing that in. It really is a lot of bond managers who've come out and said that. Jupiter, for example, they think Treasury yields could go to 2% as the Fed faces a recession and needs to cut. Of course, on the other side of things, people who aren't necessarily dealing directly in the bond market or aren't themselves, like Jamie Dimon, he said yesterday on Fox Business that perhaps they will need to go above 5%. But here's the thing, is because the market has started to price this in for the first time in some time, we have no longer restrictive financial conditions. If you take a look at the Bloomberg FCON index, it's the first time since April that we are now into easy territory. And this is why Powell yesterday raised some eyebrows, not because of what he said, but because of what he didn't say. He didn't push back against the rally in the bond market, in the equity market that's caused easier conditions. So whether he meant to or not, some folks did interpret that as an implicit endorsement of the rally we've seen of someone like Jeffrey Gundlach.
Can I just to clarify something for a stupid stocks guy like me? Right now, we say the Fed is at 4.5%, right? Because we're talking about, when we say that, the upper bound. They want to hold rates between 4.25 and 4.5. They're widely expected to raise 50 basis points to 5% in February, which is why the market is pricing 4.9, because really it's 4.75 to 5%. So when Gundlach says the Fed's not going to get to 5%, I mean, they're going to be there in 3 weeks.
Well, see, this is the thing, Matt, why that the terminal rate conversation, the gap between the market and the Fed isn't the massive thing. It really is that cut of what happens afterwards. Of course, Matt, though, I could also say that some folks think that or some Fed speakers have talked about going further than 5%. So, I mean, the devil is really in the detail, just saying they'll get right up to 5%. to your point, that's not too different than what we're seeing in terms of some of the pricing what the Fed has said.
Okay, Danny, thanks very much. Bloomberg's Danny Berger. Yeah, a lot of market focus on that 5, whether it'll be the conversation that happens after that that will really matter, or later through the year. Right, Eurozone inflation is in focus. It remains near a historic high, of course, but sentiment around the economy does seem to be improving. Bloomberg's Maria Tadeo joins us now from Brussels. Maria, the European economy took a battering last year, of course. Yesterday, we talked about Goldman Sachs' new forecast saying the economy won't go into recession this year. Today, we've got news about inflation expectations looking fairly normal, which is a big deal. Has Europe turned a corner?
Yes, Anna. I mean, it's Happy New Year. I'm Spanish, by the way, so I say Happy New Year until March. For me, it's completely fair game. But if you put all of this together, it does seem that sentiment has changed. Remember, before the Christmas break, this was going to be the winter from hell, this recession that was almost unavoidable, imminent. And then yesterday, we had that change around with the note from Goldman Sachs. They dropped the recession call. You had Deutsche Bank, by the way, also say there is upside for the euro because of the China reopening. And then, of course, we've seen gas prices go down. The next logical step is that consumer bills will go down. And then yesterday, I sat down with the Belgian Prime Minister, Alexander De Croo, and I asked him, is the worst over? This is what he had to say. Let's take a look.
If you look at the economic indicators, indeed, the fear for recession is diminishing. And there are good reasons for that. One of the reasons is indeed on the energy side. A number of things have helped. I think, first of all, the agreement on the gas price cap was a necessary one.
Which you pushed for a lot.
And which we pushed for a lot, and is a strong indication that in Europe we will not pay these very high prices anymore.
And that was the Belgian Prime Minister, of course, yesterday. He sat down with us exclusively on Bloomberg TV, and you heard it. The idea of this recession seems to have diminished. For me now, however, the real question is what happens with the European Central Bank story. If you go back to December, Madame Lagarde was very clear that she would continue to hike, that the central bank would not pivot. She talked about restrictive, potentially. She talked about multiple hikes, guided the market very well to 50 basis points. How will this new narrative feed in Frankfurt? That's, to me, the real question now.
All right, Maria, I want to just point out that Larry David, who made a fairly prescient call, it looks like, in his FTX commercials on crypto, says you can't say Happy New Year after January 7th. That's the cutoff, the official cutoff.
And listen, I'm Spanish. For us, Christmas ends on January 10th, and I continue to say it for months. Why not? It's nice. It's a nice thing to do.
Well, I respect the Spanish. Maria Tadeo, thanks very much for joining us out of Brussels. Let's get to Switzerland. Credit Suisse is considering cutting the bonus pool for 2022 by about 50%, according to people familiar with the matter. The news caps a grim year in which the bank was forced to raise $4 billion after a string of losses. For more, we're joined by Marian Halftermeyer, Bloomberg finance reporter out of Zurich. So what do we know about the payouts this year?
So it's looking a bit grim, but that being said, we have to put this into context of the broader Wall Street. It's not great for many banks right now. I mean, there were some banks looking at 30–40% drops in bonus pool as well. It is a bit more severe in Credit Suisse's case just because of the year that they've had with the restructuring and the capital raise, and they are really trying to set themselves on the right foot and turn around. But this is certainly not encouraging for all those employees who have stuck by them.
And remind us of some of the big name departures and the issues that this bank has faced over well, years, Marian.
Yeah, exactly. So they've been seeing a lot of talent bleeding over the last 2 years, and that stems really, we have to go back 2 years to the Archegos scandal and the Greensill scandal, which caused a lot of losses for the bank. And since then, we've seen the bank have a series of management changes, different CEOs and chairmans, and strategy resets. So we finally had the latest strategy reset in November, and that has, been a bit severe. They're doing job cuts, and they're planning to carve out the investment bank. So a lot will be happening this year as they execute on that, but it will be difficult because they do have to walk that fine line of retaining talent as well.
Marion, thanks very much. Bloomberg's Marion Halftermeyer with the latest on Credit Suisse, that ongoing story, of course. Turning to tech and another ongoing story, Bloomberg's learned that Apple will start using its own custom displays in mobile devices as early as next year. That's a blow to partners such as Samsung and LG. Bloomberg's Tom McKenzie joins us now with a look at this. And I was looking for a response in the Samsung share price, and we saw it a bit more perhaps in LG earlier on. So what do we know about the time frame for this change? Today it's screens. Yesterday they were talking about chips.
Yeah, and to your point, this is part of a sweeping shift by Apple to bring more of these components in-house, but it's going to be implemented in an incremental way. And on the time frame in question, they're going to start with the high-end, the high-value iWatch, essentially, the smartwatch, by the end of 2024. It's a smaller screen, so it makes it a slightly easier prospect. And the difference is the screen is going to be shifting in terms of the type of screen from OLED to micro LED. But importantly, of course, they're going to be building it, or at least designing it, in-house. I'll have to get an external manufacturer to produce it en masse. But it is that shift. The time frame then, end of 2024 for the watch. Then at some point, they'll change these screens as well and build them in-house for the iPhone. They don't have a time frame around that. But again, to the broader point around this sweeping change from Apple, we have seen, yes, earlier this week reporting that they're going to switch up the Broadcom chips for their own in-house chips, and they've already dropped Intel chips within the Mac. So it's part of that sweeping shift. It's going to be done incrementally. They had some technical difficulties in getting to this screen shift that's held them back. They started this whole process back in 2018, but now they're determined to get to that point by the end of 2024 with at least the smartwatch.
I mean, you know, I wonder when I read these stories, and for years we know that Apple's wanted to bring its entire supply chain in-house. When are they going to be done? When is Apple going to make everything, Tom?
Well, it's still a number of years away. You look at that time frame, they're just starting again with the watch by the end of 2024, if they get to that point, and then years away in terms of the iPhone. So it is going to take time. It's highly complicated engineering, of course. What it enables, or what they hope it'll enable it to do, is to be able to better customize those devices, and to your point, have better control over supply chains. We don't need reminding of how important it is to have control of your supply chain. So that's the rationale. And in terms of the impact, of course, and Anna, of course, mentioned this in the lead up to some of those suppliers, the likes of LG, they get 36%, LG Display, 36% of their revenue from Apple. Samsung, a little less, 6.6%. But nonetheless, you saw those stocks under a bit of pressure on the back of this news. It will take time. It is consequential for Apple. And of course, it's consequential for its suppliers as well.
All right, Tom, thanks very much. Tom McKenzie reporting on the Apple supply chain changes today. We've seen them, of course, over the last couple of days, as Anna mentioned. Let's take a look at some of the stocks we're watching in the pre-market this morning. Bed Bath & Beyond, again. It is a penny stock now, so any little move is huge in percentage terms right now, up 24%, even after reporting a wider net loss than had been expected yesterday. That underscores the likelihood of a bankruptcy filing in the next couple of months. Also, CarMax. JP Morgan cutting CarMax to underweight from neutral. The new price target at JPM is $60 a share. That implies an 11% drop from the closing price yesterday, but in the pre-market, it's down almost 5% already. And World Wrestling Entertainment, WWE, is up more than 6%, almost 7%. It said yesterday its board unanimously elected Vince McMahon as executive chairman. His daughter, meanwhile, Stephanie McMahon, has resigned from her roles as chairwoman and co-CEO. So a lot of drama in a stock that really thrives on drama, Anna.
Yes.
That's the whole point.
Yeah. Drama in the wrestling world and spilling into the markets. Right, coming up on this program, we'll talk markets with Yogi Dewan, CEO at Hassiem Asset Management. Is there still hope of a soft landing for the US economy? Yogi can explain why he thinks so, and why Elon Musk may never again be the world's richest person. Read today's big take story on Bloomberg.com or on the Bloomberg terminal. We'll get details later. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lyons is on assignment today. Joining us now to look at the markets, Priscilla Azevedo-Rocha, Bloomberg credit reporter. So let's delve, Priscilla, good morning to you, into the world of credit. And I read from you and colleagues that we've seen a deluge of debt sales in Europe that's pushed issuance for the year beyond $150 billion in the quickest time ever. Why so much excitement in a rising rates environment from corporates to raise money now? I suppose it's because of the rising rates environment.
Yes, that's right. Thank you for having me, Anna. So the market at the moment is very benign. So companies and banks in particular, in Europe is mostly financials focused, but the corporate world is taking opportunity of this moment where investors are coming back to the market. They have money, they're cash rich, and they're looking ahead. Okay, the broader concerns in the market remain. So inflation is still out there. There's a rising rates trajectory. So January is usually a good month for bond sales, right? So why not go now?
Yeah, well, and also it's very popular, right? Over here, yield to worst on IG is like more than 5%, and for junk bonds, it's more than 8%. So investors are loving this landscape. Is that the same in Europe?
That's right, Matt. That's absolutely the same in Europe. So basically, a corporate bond in Europe at the moment is paying about 4%, right? If you look back, only 2 years ago, they were paying about 0%. So at that time, investors were fighting over 1 basis point. Now the market has fallen so much last year, you know, so for investors it's a great entry point because it is coming from such a low point that is a great entry point and is having higher returns. But it's not the same picture for everyone. The junk market remains pretty much closed here because the companies that were paying like 8% last year, now they risk falling into defaults or into administration and things like that. So the market is open, but it's not open for everyone.
Yeah, Euro high-grade bond spreads I see near the lowest since the summer. To your point, Priscilla, thank you very much for joining us. Bloomberg's Priscilla Azevedo-Rocha with the latest on credit markets. And for credit markets and much beyond, check out the Markets Live blog. You'll find market analysis there across asset classes. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. President Biden says he was surprised that classified documents were discovered in an office he used before he was elected. He says his lawyers did the right thing by calling the National Archives, which took possession of the papers the next day. Congressional Republicans are promising to investigate. In the UK, ambulance workers are on strike again today. Members of 2 unions are walking out as part of a dispute in pay in the National Health Service. The public's been warned they may have to wait longer, even longer, for emergency services. And Tesla plans to spend more than $700 million in investments on the Austin, Texas campus of its new factory. According to filings, the money is earmarked for a ground-up and complete interior finish of the electric vehicle plant. Construction starts later this month. At the Golden Globes Awards, Steven Spielberg was a big winner. The veteran Hollywood filmmaker won Best Director for The Fabelmans, which is based on his life, and the film won the Golden Globe for Best Drama. I have not seen it. I don't think I've seen any of the movies, but I don't even really know much about the Golden Globes. Isn't it kind of like an also ran after the Academy Awards?
I don't know, but now I've got an even longer, it's annoying, I have an even longer list of things I've got to watch and will fail to find time to watch, because that's just what happens when you get older, isn't it, Matt? The Banshees of Inisherin also did well in the awards, but that'll be on my list. Whether I'll get to it will be a different matter.
It's not about the age, it's the offspring, right? If we didn't have kids, we would watch every movie.
There we go. Found someone to blame, and they're definitely not listening, so that's safe. Right, when we come back, we will talk about markets, though. Yogi Dewan will join us, CEO of Hassiem Asset Management. Now, that conversation you don't want to miss. He still finds room for a soft landing for the U.S. economy. This is Bloomberg.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies, and I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Fixed income mogul Jeffrey Gundlach says if you want to know where interest rates are headed, don't listen to the Fed. Instead, he says, listen to the bond market. Inflation in the Eurozone is still near an all-time high, but consumer expectations about higher prices are fading back to more normal levels. And Apple wants to bring more components in-house. It will start using its own screens for iPhones and Apple Watches in a big blow to Samsung. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lines is on assignment. And European markets, US futures to some extent getting a bit of a boost from what seem to be high expectations that we get a moderating in some of the important parts of the US inflation story when we get that CPI data tomorrow. We'll see whether that is well-founded high expectation.
It's a good point. I mean, the really important day for equity markets is tomorrow when CPI comes out. But maybe markets are, you know, listening to Jeff Gundlach today. Maybe markets are optimistic about inflation expectations, as it seems Europeans are. In any case, we do have futures up again here, about 1/4% on the S&P. Not huge, but you have less competition from yields. And this is true, I know in Europe and around the world as well. U.S. 10-year yield coming down about 5 basis points right now, 357. Maybe that makes stocks a little bit more attractive as bonds are offering less. NYMEX crude, a little changed right now at 75.24 a barrel for West Texas Intermediate. So maybe it's not, you know, growth expectations that are moving stocks, but really a lack of inflation concern. And then Bitcoin, also little change, but at $17,449, it looks like it's finally broken out of that $16,000 range, at least for the last 3 sessions. In terms of the pre-market movers this morning, we're definitely keeping our eye on Apple. Not a huge movement, but a huge stock, obviously. More news that it's planning to use its own stuff rather than outsource. Today, it's custom displays in iPhones and Apple Watches, replacing stuff made by Samsung as early as next year. Meanwhile, Bed Bath & Beyond reported a wider than expected loss yesterday. That underscores the likelihood of a bankruptcy filing within the next couple of months, but I don't think that's any news to shareholders. So the stock is in the pre-market rallying 30%. Of course, it's only a $2 stock right now. CarMax is down another 5%. JP Morgan cut its rating on CarMax to underweight from neutral, so now it says sell, and they have a price target at 60. That's 11% lower than the closing price yesterday, but we're getting obviously ever closer to that as we drop today. And World Wrestling Entertainment, WWE, is up after the company said it unanimously elected Vince McMahon as executive chairman. His comeback forces his daughter out. Stephanie McMahon has resigned from her roles as chairwoman and CEO. Anna, what do you see in Europe?
Yeah, interesting to see that family keeping the wrestling to the boardroom and out of the ring, which sounds safer. Let's have a look at where we are on Europe then. European stocks making gains today, Matt, up by 0.6%. Broad-based gains across European stocks and keeping up with this positive about Europe theme, which seems to be something that a number of investors talk to us about of late. Is it the benefits of the reopening in China, but certainly or the mild winter? Certainly a lot of optimism around Europe. The retail sector is one sector that's doing well today, up by 1.7%. We've actually had a mixed set of reports today, and this comes ahead of a number of other companies that will be reporting tomorrow. Certainly in the UK space, pretty mixed today. Sainsbury's down, JD Sports on the rise, and it seems the market going with the JD Sports line, and so the sector up by 1.7%. Direct Line Insurance, it sells insurance to retail consumers, and they had a tough December. The bad weather in the UK, the cold weather in the UK led to more claims, and that means they're not going to be able to pay their final dividend. They declared that this morning, and the stock has been punished as a result. A big move on that one. Copper is up by 1.3%, but the story really, and the red headline across the Bloomberg earlier on, is that the copper price has gone above $9,000 a ton for the first time since June. Another case of the Chinese reopening story lifting some assets, not all, of course, because it hasn't done the same things for the oil price, as we know.
All right, we're going to keep our eye on those commodities. Right now, I want to go right now, though, to Yogi Dewan, CEO of Hassiam Asset Management. And Yogi, I want to get your take on rates, because that seems to be, at least to some extent, what's moving markets today after Jeff Gundlach said, don't listen to the Fed, instead listen to the bond market. Do you agree?
No, you've got to listen to the Fed. The Fed drives the bond market. It's pretty clear markets are pricing in rates going from 4.5% up towards 5%. Our view here is that we're unlikely to see the two rate hikes that the market is pricing in. Maybe we will see one and then a pause, and a lot really depends on two things.
Hang on, you don't think the Fed's going to raise 50 basis points on February, what is it, 2nd, February 1st?
I think there's a significant risk that they'll only rise 25 basis points, and then another 25 basis points is priced in for later. But at the moment, it really depends on each and every print that we get in terms of economic data. We've got the CPI number out tomorrow, as you've already said. Market is expecting 6.5 to 6.7%. That's a significant decline from an inflation perspective. And of course, the thing that drives share price appreciation is earnings. An earnings kickoff on Friday. We've got Bank of America, JP Morgan, Wells Fargo. And obviously Q4 is not going to be a great season for earnings. We've got earnings growth of -4%, but revenue growth of 4%. And we know that the banks are all going to cost cut. We've seen what Goldman have just announced as well. So our view here is that stay focused on earnings, look at guidance, see what the CPI print is, listen to the Fed. Also, you've got to look at what's going on in Europe as well, which is quite meaningful from a rate perspective too.
Yeah, absolutely. Good morning to you, Yogi. More on Europe in a moment, but just to linger on what your view is on the Fed and where we head on US equity markets. You're expecting, or global ones actually, you're expecting global equity markets to be higher by the end of the year. Is that because you expect a very bad or a very good outcome for the US economy? Because it seems with either conclusion, you can come to a place where you see stocks as higher. So is it driven by the fact that you think that the US economy won't worsen that much? Or is it because you think it'll worsen so much that the Fed will cut?
Yeah, we're long-term investors, so we're not short-term focused in the way we are looking at things. At the moment, we're looking at economic data, which is very mixed. We're looking at earnings data. We know that Q1 and Q4 this year are not going to be good. Our view is that things will pick up in quite a meaningful way towards Q3 and Q4. We're expecting the S&P 500 to be significantly higher by year end. What happens on a day-to-day basis around each and every print is quite hard to work through from an investment perspective.
Yeah, but what drives that second half optimism, I suppose, then?
I guess there's a number of things that are actually going on. I think inflation will moderate. I don't think we'll see as many rate hikes as expected, so you'll start to see bond rotation out of fixed income into equities again. We're also quite pleased to see China reopen, not with all of the COVID deaths, but remember China with zero COVID still had GDP growth of 3.9%. As it reopens, we expect to see things improve. That will benefit Asia, which in turn will benefit Europe, which in turn will benefit the US. So we think the longer-term prognosis, particularly in the second half of the year, is a positive one.
So you're optimistic on the economy and not as fearful as the Fed. This isn't an expectation for a Fed pivot on a recession.
Yeah, we're not expecting a Fed pivot. We're not expecting rates in the way that they're priced to actually start to decline around June, July, which is what's happening in the US. And in fact, even in Europe, they're talking about rate cuts later on in the year. Let's not talk about the UK in this regard, because that's a separate point altogether. But from our perspective, we expect to see some rate hikes, not as much as priced in. Sentiment is quite negative. All investors are positioned in a very defensive way. And our sense here is that a lot will happen around COVID, a lot will happen around China, a lot will happen around the war, and earnings, it's earnings that drive share price appreciation, and that's what we're actually going to focus on.
Yeah, and I don't think everyone, on this side of the pond quite appreciates the European-Chinese connection, the bridge there that's so beneficial to the European economy when China reopens. We've seen outperformance already of European stocks. I know it's we're just on January, January 11th today. Do you expect that to continue, European outperformance over U.S. equities?
At the moment, Europe's up, some 7% year to date, whereas the US is only up some 2% year to date, depending on which index you look at. The thing to remember about Europe is forward PEs are only 12. In the US, they're 17, and in the UK, they're 10, and likewise in China. So you've got a very strong narrative around valuation in Europe. You've got an improving sentiment around China. You've also got a lot of stimulus that will likely be pumped into the economy, and you've got higher rates, according to Lagarde, 2.5% going up to 4% by year end. Higher rates means banks can lend. That helps stimulate growth. Fiscal spending will help stimulate growth. So we're really now focused on what goes on in Russia and Ukraine. We've had a milder winter. We've seen natural gas prices moderate. We've seen oil prices moderate. It's hard to see the inflation narrative continuing. It's hard to see as many rate hikes being priced in actually taking place. So our sense here is that investors are just positioned really defensively. They will focus on value, and this will help European equity markets outperform going forward. It's a value play.
Yes, and I know that that's something that takes you to Europe, doesn't it? What about the UK? You mentioned it in passing, but it is a different story. I mean, some of the moves, if you see China reopening benefiting commodities, then that can be positive. But is it more a case that that dynamic will benefit Latin American commodity producers and the like, rather than the UK markets?
Yeah, the UK seems to have a lot of domestic issues in terms of what's just been happening with the new government, all the striking that you've made reference to, and that will eventually impact on earnings. It's definitely impacting on consumer spending. So the recovery in the UK is likely to be a slower one. Now, that said, forward PEs are at 10. Sterling is relatively weak on a PPP basis versus the US. And of course, the FTSE 100 revenue stream is predominantly US dominated. So you'll start to see some areas of support, but we think the recovery will take a lot longer.
Okay, thanks so much, Yogi. Good to speak to you. Thanks to Yogi Dewan of Hassiam Asset Management joining us this morning to talk about his market views. And coming up, we'll have a conversation about what CEOs expect for the year ahead. Most CEOs are fearing recession worse than the financial crisis. That is the view coming out of a survey conducted by EY Global. We'll talk to their Vice Chair, Andrea Grazzoni. He'll be with us to talk through the latest report. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Part of what I love about business is you get to build things from nothing.
I don't have any investors. This is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lyons is on assignment today. Now, a new report from Ernst & Young found a majority of CEOs fear a recession will be worse than the financial crisis. Joining us now with his report is Andrea Guazzoni, EY Global's Vice Chair for Strategy and Transactions. Andrea, very nice to have you with us. So this research by you at your team at EY, tell us what it is that is driving such a sort of pessimistic conclusion from global CEOs.
Thank you very much for having me. I think the situation is really mixed, and you can clearly see from the answers in this survey that involved more than 1,200 CEOs that there is really a combination of negatives that is impacting on their view regarding next year. So basically, 98% of the CEOs interviewed believe that this is going to be a downturn. And I think their view regarding the severity of this downturn is very split. I mean, a significant number of those CEOs believe that it's going to be mild and to a certain extent quite extended in terms of timing. Others believe that actually it's going to be deep. And there is a significant number of those, a majority actually of those responded, who actually believes that to a certain extent it will be even tougher than the financial crisis.
Andrea, can I jump in here? I got to jump in here. If a majority of the respondents think that this recession is going to be worse than the great financial crisis, that doesn't sound mixed at all. That sounds horribly pessimistic, dramatically so.
It is to a certain extent, but I think that probably, I mean, it's difficult for the respondents really to reconnect what happened during the financial crisis with the last 2 years. So I do believe that there are a lot of items in the survey that actually points to the preparation for something that could be very severe. You see their attitude towards restructuring, cost-cutting, outsourcing, and all the CEOs interviewed really pointed out that these are going to be very important measures to control the situation in the next couple of months.
So I think what most of our viewers right now are wondering is, what kind of bonus am I going to get? What kind of raise am I going to be able to negotiate? You know, it's that time of year. What are the CEOs telling you?
I think that they are preparing really for this environment where the level of uncertainty, mainly caused by the geopolitical situation and uncertainty regarding the rates and inflation trends, would require very, very severe measures in terms of managing internal costs and managing their P&L. So overall, I think that's positive. I mean, it's a positive way of looking at the future scenario in a way that is proactive. And if you look at the other side of the coin, I mean, you see that a predominant majority of those CEOs are actually planning to do more M&A to stimulate growth and to invest in areas where they think that they can have a better return in terms of capital deployed. So it's a quite balanced view, actually. It's prepared for the uncertainty we all see coming up, and at the same time trying to make the organizations more efficient, more effective.
Okay, yes, I wanted to turn to M&A, Andrea, because you, in your role, Global Vice Chair for Strategy and Transactions, clearly have some visibility around transactions and the type of things that CEOs are talking about. So if 89% want to leverage deals over the next 12 months, what kind of deals are they going to be? One of our colleagues was recently writing about expecting deals in 2023 that secure up supply chains. Is that the kind of activity that you'd expect?
Yes, I think we can see really a continuation of the trend we observed over the last 6 months. And there's an obvious appetite for investing in certain sectors, in particular in the technology sectors. I mean, there's an element of technology in every deal now, but I think there are other sectors like consumer products, oil and gas, energy, renewable, are going to become very interesting for obvious reasons. And I think that the kind of deals will continue to remain small, medium-sized, which was the trend really over the second half of 22. And I think we'll be more focused on, let's say, the so-called friend countries. So we can clearly see the cross-border activity declining, especially with regard to certain areas. But I think this will be compensated for more activity domestically and focused and between the countries where there are already friendly relationships. So that's the kind of trend we can see. Obviously, the volatility and the stock market and the higher interest rate, but above all, I think really the uncertainty regarding the interest rate trends are going to represent significant headwinds in the coming 6 months.
Yes, indeed. Okay, Andrea, thank you very much for giving us your time. Andrea Guazzoni of EY with the latest on their research. So a majority of CEOs fearing a recession that will be worse than the financial crisis, but still committing or expressing an interest in some M&A. Coming up on the program, Elon Musk may have forever lost the title of the world's richest person. We will see. Up next, we'll discuss why that might be the case and what is happening to his wealth. This is Bloomberg.
brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Kaylee Lyons is on assignment in San Francisco at a very important healthcare conference. We hope she comes back soon. Elon Musk might never be able to reclaim his title as the world's richest man. With the ongoing Twitter drama and Tesla's stock tanking, his net worth has fallen more than $200 billion. Not $200 billion, but by more than $200 billion from its peak on the Bloomberg Billionaires Index. Today's Big Take stock examines plummeting personal fortune, and Ben Stupples, our ultra wealth reporter, joins us now to talk about this. So just a massive collapse in Elon Musk's wealth. The first thing I wonder is, Ben, do you think he cares? Because he still has tons of money.
You're right, Matt. He does still have tons of money. He still has a net worth of about $130 billion. Now, let's just think about that number for a second. It's almost enough to buy every team on the NFL. Having said that, losing $200 billion, that is significant. That is significant. It's worth thinking how that was fueled to start off with. It was Tesla's rise in 2020 of more than 700%. 700%. And the collapse that we've seen since then is pretty incredible.
Pretty incredible. And of course, he enjoyed all of that on the way up because he he had a number of stock options that he was able to benefit from. You talked about sports teams and how many he could buy with his wealth. He doesn't like to play with sports teams, though. He likes to play with social media, and to some extent was distracted from Tesla, so the argument goes, by what he's doing at Twitter. How much is that? How much is that responsible?
I think it's hugely responsible, Anna. I think obviously the macro picture's changed massively for Tesla since 2020. The macro picture's changed. Investors are now concerned about rising inflation, interest rates, making people less, wanting an EV vehicle potentially less. But Elon Musk's sideshow with Twitter has made investors really question his leadership of his biggest asset, which of course is Tesla. He needs, some investors would argue, to focus back on his baby, which is Tesla, of course.
We talk about, Ben, all the time, paper wealth, what these ultra-rich people are worth if you look at the value in the stocks they own, the value in the companies that, for example, SpaceX, represents a big part of his wealth. What about real lasting wealth? How much do you think he has in terms of, actual cash in the bank that he can pass on to his, 12 or 13 kids?
I would say, Matt, right now, that's, for Elon Musk, a $130 billion question, his current net worth on the Bloomberg Billionaires Index. To be honest, we may never know the true answer of that, but what we can say is that, Elon Musk has sold a lot of Tesla stock over the past year. At the same time, though, along with that paper wealth, he was borrowing against that Tesla stock. So in addition to cutting his stake, he was turning the paper wealth into actual cash on the side, which he used to partly fund the Twitter takeover. He's also used margin loans in the past from Morgan Stanley to buy homes. He's now sold them. But that paper wealth, he has actually turned at the same time into cash on the side. We will never know the full answer. It's the great mystery of working on the ultra wealth side for Bloomberg News.
Okay. But he is certainly a big fan of the margin loans. Thank you very much, Ben, for bringing us the story. Ben Stupples, and you can go to NI Big Take on the Bloomberg Terminal, or find that story on our website, all about Elon Musk and whether he will ever be, again, the world's richest person. Now, that is it for Early Edition. Surveillance is up next. This is Bloomberg.
we've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
At the end of the day, we have this set of circumstances where the Fed is intent on reining in the labor situation.
The higher that prices remain, that's going to force the Fed to raise rates higher and potentially keep rates higher for a longer period of time.
We're expecting just a 25 basis point rate hike and think the Fed might even be able to pause from there.
We're kind of moving totally out of the inflation regime. We're moving into something new.
Disinflation in the second half of the year will kind of filter through into core, and the picture will look very, very different.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Waiting for inflation data in America. CPI Thursday just around the corner, Tom. You excited?
It's not CPI Thursday. Sam Goldfarb over at the Wall Street Journal nails it. It's Supercore CPI Thursday. Supercore.
CPI Thursday.
This is where Chairman Powell is and a lot of other people. Services, ex-housing, maybe services, ex-housing. Ex-this David Rosenberg's rolling over in his grave up in Canada saying you don't disassemble inflation. It's a sum of all these different parts. We'll do that tomorrow.
I'm not sure that branding's going to work. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Tom Keene. I'm Jonathan Farrow. Lisa Abramowitz is off for a couple of days. Bramo's going to be back with us on Monday. Equity futures right now on the S&P 500 positive 0.2%. TK, the gloom out there. Does the gloom stack up with what we're seeing in this market? So I went through the numbers this morning. EM equities back in a bull market. Copper prices back through 9,000. European banks, Eurozone banks, Tom, are up more than 40% from the lows of last summer. Make sense of that.
The mat of the gloom 3 weeks ago, I'll let you decide 4.5 weeks ago, whatever it is, and you list all these different items we see on the Bloomberg terminal. We have an extension of accommodation today, John, out a positive number out to 0.06 standard deviations. All you need to know, that confirms all the good news you're talking about.
Is it a conundrum for Chairman Powell and this Federal Reserve?
Huge, massive. Conundrum does it.
Mike Gapin of Bank of America says it's not. This doesn't have to be a major problem. They shouldn't obsess over the fact that this market's pricing in rate cuts.
I agree, but nobody cares about my opinion. I'm going to state that the accommodation we're seeing and the good news we're seeing here is something he can't deal with until he sees inflation break. We may see that tomorrow.
We get that tomorrow morning. I have to say today, light on data, light on Fed speak. Maybe that's good news for many of you. Right now, let's whip through the price action. Equity futures up 0.2% on the S&P 500. Yields come back in on a 10-year, down by about 4 or 5 basis points to 357.24. We've got to talk about foreign exchange in a moment, Tom. Euro dollar 107.48, up 0.1% there. Just the renewed optimism of the last couple of days off the back of maybe that Goldman note suggesting that we can escape recession in the Eurozone.
Am I doing the brief?
Would you like to do the
I'm
brief?
doing the brief.
What's coming up? What have you
Folks,
got?
here's the brief. It's a Pharaoh Keane brief. Bramo is so gone, Gareth Bale retired. I'm sorry, John. Kick the ball from outside. I don't know anything about soccer. I love this guy. He's like Grealish. They just make things happen.
Early 30s, very young to retire. Very, very young to retire.
Bad knees like Bobby Orr?
No, I think he's fed up with the game and wants to play golf. That would be my personal opinion on the matter. I don't think he was well respected at Real Madrid, despite how much he won there.
That
wasn't loved by the fans at all.
Oliver Brown in the Telegraph, I read every word, and that's what he said.
Ugly fell out with the club, and it looks
Why
like he
can't
got
he
bored
go
of
back
football.
to Tots and play 7 minutes?
Well, he did play for Tottenham for a little bit, didn't he?
come
He went
back.
back there.
Yeah, come back.
I don't think that's what Antonio Conte's looking for right now.
We've never had a brief like this.
This happens sometimes. Sometimes players just kind of leave. Do you remember Zidane walking away from
Yes,
football
I liked
after
him.
the 2006
I had no idea
World
why I
Cup?
liked him. And he didn't get along with Bale, I read.
Just a beautiful player. When he coached the team?
Yes.
Yes.
Yeah.
Yes. I didn't think we were doing this today.
This is a brief.
That's the brief.
It's a surveillance brief,
I'm not sure.
brief this morning.
That's not the
Cheers.
brief.
Cheers, right there, John.
Not the brief that Bramo
Cheers.
would approve of.
Don't
but
spill that in my tang.
Oh,
Okay,
cheers.
there we go.
Just delicately over the Bloomberg terminal. Vasilios Giannakis joins us now, head of European FX strategy at Citi. Vasilios, let's talk about that. In the face of all this global recession talk, the market's having a different conversation, isn't it?
Oh, absolutely. And I think to a certain extent, these forecasts about recession are a bit outdated, and they're based on a number of forecasts that were produced back in Q3 and beginning of Q4. This is not to say that there are not going to be a number of economies that are going to experience a sharp slowdown or even a recession, the UK being one of them. But I think there's been a significant and massive change in the market narrative in Q4. The initial headlines about China reopening morphed into concrete and very quick and swift action. There's been further support in the housing sector in China. And I think what we're currently seeing is that there's a drastic mindset, a change in mindset, which caught me by surprise as well. To support growth in China is basically shifting the focus of the market into a re-rating of global growth expectations higher. And I think this is precisely what equities are telling us. This is what relative equity performance is telling us. And that's definitely what the dollar market is telling us.
Well, let's push it through the FX market. The peak of the US dollar was late September, the low in euro dollar around the same time. That low on the euro was about 95 cents on euro dollar. Right now, we're back to 107.50. What kind of upside are you thinking about on a single currency now, Vasilios?
Well, I think right now we're at very critical levels. I think 107.80 is going to be a level that has proved to be in the past quite a strong resistance area. If we clear that level, obviously we're going to see a lot of leveraged money buying into further upside, and potentially this is going to imply that real money accounts are also going to follow through. But then again, fundamentally, you have to take a step back and say, what do our fundamental models suggest, fair value models suggest? And I think right now we're gravitating towards a fair value range of 112 to 115. Clearly, we're still pricing a risk premium because of the Fed, because of we're not certain how the China reopening is going to pan out. But I have to say, first of all, I don't think that a 25 basis points repricing higher or lower in the Fed is neither here nor there for the market and for the foreign exchange market. And assuming this, and assuming that we get a relatively smooth China reopening, which implies a pickup in domestic demand and therefore Chinese and imports, yes, I think we can gravitate towards this level over the course of the next few quarters.
Vasilis, that's right where I wanted to go. And I'm talking about you and your great FX team, but also all of Citigroup, and including Ed Morse's world-class call on oil last year. Are we fighting the last war? Are we fighting right now intellectually the 2022 war, and that World Bank has China growing at 4.whatever%, and Ed Hyman and Evercore ISI have China growing at 6.2%? It seems to me right now there's a whole, not gloom crew in honor of Bramo, but just a cautionary crew not modeling in the potential upside of 2023.
Oh, absolutely. I fully agree with you. And you know what? I think you hit it in the nail, because a lot of the discussions I have been having with especially U.S. clients, if I measure the time that I spend about talking about the Fed, it consumes about 65 to 70% of our discussion. And that was the big market thing back in 2022. But since Q4, we have had a massive shift in market narrative. It is pretty much all about China right now. And if this thing pans out relatively smoothly, as I said, it will have hiccups, especially in Q1, which is going to represent, let's call it the trial period of how things are going in China. I think it can prove that the change in the mindset in Beijing can actually bail out global growth and morph into an upside in global growth and upside in global trade as well.
So is this the repeat of the post-financial crisis playbook, Vasilios? Do you remember that when China bailed out global growth? Is this a repeat of that?
To a certain extent, it can be. Look, I don't want to draw parallels with the great financial crisis.
No, of course not.
Largely because we were hit by completely different shocks. Back in the GFC, we were hit by an endogenous shock. Right now, we initially were hit by an exogenous shock, which was COVID, which started building, a lot of saving buffers and eventually meant that we had to deal with extremely high levels of inflation. During this past 2 years, China has been completely shut, or at least to a large extent shut from the rest of the world. And all these bottlenecks, I think, they're going to start, getting released. They're going to start become less of a hurdle into the various trade chains and the trade channels. And I think this is a big positive for global growth.
Vasilios Giannakis of Citi.
It's brilliant.
Vasilios, just fantastic.
Great to start.
Over at Citi, a little bit more constructive on the outlook. When we talk about China, we've done this a few times on this program over the last several weeks. You've got to break it down just quite simply. Demand side questions, supply side questions. On the supply side, does it deliver supply side relief in the way that Vasilios expects it to? Or does it lead to further supply side dislocations off the back of that big demand that we're expecting?
I'm going to go to Jonathan Spence at 101. They have one mandate within their totalitarian regime, and that is to marginally employ the people. And that means fiscal stimulus, and particularly a bailout of their domestic real estate business. And that statistic yesterday from Julian Emanuel and Ed Hyman of 6.2% China CPI doesn't get you to the gloom of a good institution, World Bank. We've got Malpass coming up.
And looking forward to it.
And by definition, they have to look back. I get that. Giannakis is looking forward and seeing a better day.
And Malpass is looking at maybe a one handle on global GDP. The price action is not confirming that outlook in any way, shape or form.
Yeah, I will always defend these institutions. They are institutions. They have to look backwards, and that's what I saw yesterday from World.
I get all of that. So for an investor right now, you've got to answer a simple question, Tom. I've been asking it. Should you price in a global growth rebound off the back of China reopening, or should you price in a global growth slowdown off the back of monster financial tightening?
You should tune into Bloomberg Surveillance tomorrow at 8:30, where we will look at super core inflation along with everyone else. And these are the drips: Spanish inflation, French inflation, 3 other inflations I can't remember, John. Even the United Kingdom with a warm Europe, maybe a better nat gas pricing in Europe. These are cumulative good newses on disinflation.
I'm with you, though. I think this conversation can completely change at 8:31 Eastern time tomorrow morning.
Yeah.
Completely. You get an upside surprise, the conversation switches, and Vasilios is going to be very upset.
We are not de-emphasizing the inflation report tomorrow.
We're not going to do that.
We're not going to de-emphasize the inflation report.
To Vasilios' point, his frustration about the conversation being dominated by the Fed, you get an upside surprise.
65% of his tech.
It's all we're going to talk about.
John, 65% of his chat is consumed. I say consumed by Fed chat. That's almost as bad as you.
So he thinks it should be 80% China?
It's 80% with you.
You reckon?
Yeah, Fed chat.
I'm trying to bring it back in. I'm trying to lean a little bit more into the China conversation.
I agree.
Tom.
I agree.
Equity futures right now up 0.2% on the S&P. Let's round it up. Yields are down by 4 or 5 basis points. Your 10-year, 357.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden says he was surprised that classified documents were discovered in an office he used before he was elected. He says his lawyers did the right thing by calling the National Archives, which took possession of the papers the next day. Congressional Republicans are promising to investigate. The U.S. will bring Ukrainian soldiers to Oklahoma to train on the Patriot air defense system. About 90 to 100 Ukrainians will take part. Normally, training on the Patriot takes several months, but the U.S. is looking for ways to speed that up. In the UK, ambulance workers are on strike again. Today, members of the two unions are walking out as part of a dispute of pay in the National Health Service. The public's been warned they may have to wait longer for emergency services. Bloomberg's learned that Apple will start using its own custom displays in mobile devices as early as next year. That's a blow to partners such as Samsung and LG. The company plans to begin by swapping out the display in the highest-end Apple Watches by the end of 2024. And after years of scandals and multi-billion-dollar losses,
Connection lost.
Suisse is tightening its belt. Bloomberg has learned the Swiss lender is considering cutting the bonus pool for 2022 by about half. The move would bring the amount down to about $1 billion, with some employees likely to receive no bonus at all for last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Wall Street prepares for the latest read on inflation.
There's new optimism about a soft landing.
Inflation may be fading faster than some people thought.
Will headline inflation continue to ease?
It's really about the labor market, wage inflation, and services.
Peak inflation becomes your number 2 concern, and you get into a growth discussion.
Instant reaction on Bloomberg Surveillance.
This is good news for Chairman Powell.
The risk of doing too little, does it still outweigh the risk of doing too much?
How much do we see the worst of it versus just the beginning?
Inflation in Focus, Thursday on Bloomberg.
People know I take classified documents and classified information seriously. They found some documents in a box in a locked cabinet, or at least a closet. And as soon as they did, they realized there were several classified documents in that box. And they did what they should have done. I was briefed about this discovery and surprised to learn that there were any government records that were taken there to that office. But I don't know what's in the documents.
The President of the United States just in a touch of hot water. We'll pick up on that in just a moment. Live from New York this morning. Good morning. About 25 hours, 26 hours away from a CPI report in America. The Fed speak, pretty quiet today. The data pretty quiet as well. Your market pretty quiet too. The equity market looks like this. Equity futures positive, a little more than 0.1%. Yields come back down by 4 or 5 basis points, 357.24. Crude, 75.42. Watch out for this a little bit later. We're up 0.4% on WTI. Watch out for stockpile data a little bit later today, Tom, because some evidence perhaps that stockpiles have been climbing in America. So that's one to watch for later.
I agree. It's other than zeitgeist. I got Brent crude rounded up to $81 a barrel. Even though the moves are small, John, I would say they continue the trend of accommodation, of optimism, of a constructive view forward. And I'd say this mostly, John, because the VIX was 21.22, wouldn't move, and yesterday with a vengeance came into 20.75. At least that's a shift in this gentle trend.
Never mind the VIX. Hello, Jeff Curry of Goldman Sachs, and copper prices over in London on the LME back through 9,000 for the first time, I think, since last summer.
Well,
so we're talking about how to express that China reopening story, pushing it through the FX market, pushing it through equities, pushing it through commodities and base metals, Tom, in a big way.
We get a briefing now in Washington, the turmoil, the tumult that we all witnessed on the floor. Whatever your politics, it is a most interesting January in Washington. Greg Valliere is Chief U.S. Policy Strategist at AGF Investments and joins us now. Greg, there's like 14 ways to go here on your new Washington, but one has to be the quote-unquote big bipartisan win for Speaker McCarthy on China. How big a win was that? I mean, we're going to go after China. Is that news?
I think it was pretty clever, Tom. He knows there's great antipathy toward China in both parties. So he played on that, and he got a huge victory, bipartisan victory yesterday, creating a committee that's going to look at China stealing our intellectual property, trade violations, blah, blah, blah. But I do think he puts a lot of pressure on China, and he shows that he can get some votes from Democrats.
Where else can he get votes from Democrats?
Call me crazy, and many have, but I don't totally rule out an immigration deal. I don't think Biden would be a big player. His policies are incoherent, frankly, on the subject. But I think you've got a lot of people in both parties who would like to get something done. I don't totally rule that out.
Greg, starting to see some restrictions come through from various places to restrict Chinese investment in real estate. See that in Canada with Trudeau making an effort there. Heard this morning in the last 24 hours that Governor DeSantis might make the same push over in Florida. You're going to see more of that.
I think so. I think you go around the country and talk to business leaders, and to a person, they will tell you that in competing with China, that China doesn't play fair, that they cheat, that they steal things. I'm not saying I believe it, but you hear it from everybody. So, yeah, John, I think there's going to be more. And, of course, Trudeau got a smackdown from Xi a month or so ago. So the relations between North America and China are going to stay very rocky.
Well, I think the tension there, Greg, is obvious. Less obvious until recently has been the tension between the Europeans and the Americans over the investment around things like EVs. Greg, have we reconciled any differences over the last couple of weeks?
Not really. I wrote this morning, I thought the summit in Mexico was a total dud, just platitudes, nothing really accomplished, including no deal on EVs, which has a lot of countries upset. There's some big issues in Latin America, Brazil, Haiti, the wall with Mexico, but I thought this summit was useless.
Greg, what did the progressives, the far left wing of the Democratic Party, what did they learn from the McCarthy speaker fiasco? What lessons were taken from the strength and negotiating power of the far right over by the far left?
Two things, Tom, quickly. Number one, some people in the Democrats' party, feel that this gives them an opportunity to continue branding these extremists as the enemy, and that might help them. But I think the bigger takeaway is that this is going to be a tough fight. It's going to be a nasty year. There's going to be hearings. I think there's a chance Trump could get indicted later in Georgia, later in the month. It's going to be a really nasty year, and I think the Democrats got a wake-up call by what they saw over the last weekend.
We've had a nasty year. I'm going to go back to Alien Sedition Act 1801, 1802. This is normal in American politics. Scope and scale that back across our history. How nasty is nasty?
Well, I mean, when I started, I mean, you saw the fights over Vietnam and Watergate, and it's continued to go on beyond that. I mean, not to sound like a wonk, but it's about the fundamental role of government. Is it a reduced role? Is it a big role? That's going to be dominant this year.
Greg, on the front lawn of your house up in New Hampshire, you got a big poster that says we're first in the nation. Help me with the primary fiasco here. New Hampshire, literally by, I believe, constitution or law, has to be first in the nation. Is this just silly politics, or is there some substance here for our viewers and listeners?
Oh, I think that there's real substance, and that there'll be a delay, and certainly in Iowa. I think they're going to get a delay, maybe New Hampshire as well. But knowing people in my home state, I think you'll probably see that as the first primary.
Greg,
already, lots of Democrats are on their way up, including Phil Murphy of New Jersey.
Greg, can you see John Farrow at the Radisson Hotel up there in Concord, dressed head to toe in LL Bean? I mean, I'm sorry. I mean, it's just a sight to behold.
You lost me at Radisson, TK.
Not unless there's room service, John, right?
You tell him, Greg. Greg Valliere of AGF Investments. Hey, Greg, thank you. Developing story right now in the United States of America. I want to build on that for you just briefly. This off the back of reporting from Reuters. So I'll bring you their story verbatim. The U.S. Federal Aviation Administration system that alerts pilots and other flight personnel about hazards or any changes to airport facility services and relevant procedures was not processing updated information. The Civil Aviation Regulators website showed today over 400 flights were delayed within and into or out of the United States as of Wednesday, today at 5:31 Eastern Time. Flight tracking website FlightAware showed it was not immediately clear if the outage was a factor. The information's still coming through, Tom. That's the reporting that came from Reuters in the last 30 minutes or so. Yeah. If you're looking at the pre-market moves, the airlines are a little bit softer. No real drama here. We're down about 0.5% on American. On United, down 1/3%. Southwest, which has had its own troubles with its own systems over the last couple of weeks, is down 2.8%.
You can make jokes about it, but it's not funny. There are airplanes in the air. There are international flights coming in. It's boom times, 6, 7, 8 a.m. on the East Coast for all those international flights to drop in. And, you know, I don't know the details of it, but these are busy skies just with what's up there now, even if they're grounded on the ground.
When we get more information, we'll bring it to you. But that's the latest from the reporting from Reuters this morning. Elsewhere, the equity market is just a little bit firmer on the S&P 500, up by 0.2%. Futures advancing here. Your next big stop, your next scheduled stop for equity markets, the bond market, FX, as well as CPI tomorrow morning. Equities up, going into it, Tom. Yields lower by 5 basis points on a 10-year, 357.
Services and goods near disinflation. Even I've seen some charts dropping down on the edge of deflation, a negative statistic on some of the good subsets. But services just hasn't given way. You got to come back down to a 3% normal. I'm using that as a very general statement, John. But you got to get services down, not to 0, not to 2% as a Fed statistic, but just some there on a blended basis with goods that moves them in the right direction. And we're just not there yet. We may get a vector, a trend that gets you there, but we're not there yet in services.
Well, let's talk about the trend of last week. Headline data, claims exceptionally low. Payrolls still pretty decent. Unemployment 3.5%. Just that softness in wages. Maybe that reduction in hours worked. Maybe that gets your attention, Tom.
Neil Dutta, Jim Glassman, and the other optimists out there, they look really smart going into a recession that's out there somewhere.
Excited to catch up with Chris Ferrone, a Strategas, very shortly from New York. This is Bloomberg.